Hello and welcome to our South East North Off the Road webinar. For those that don't know, my name is Marcus Parajuk and I'm the Business Development Manager. We've been out and about taking our on the road sessions across the UK over the past few weeks, and we were delighted to have had hundreds of advisors and paraplanners come to join us for a coffee and to listen to what content we've had to say. That said, we are well aware of the need for online content, and for those of you who could not join us in person, we're putting on this catch-up session. A copy of the recording will also be available at the end of the week on our Info Centre portal, so if you would like to recap or pass on to a colleague, please feel free to do so. The session does qualify for structured CPD time and will supply your certificate based on your time in session via email in the coming days. We'll also send you a copy of the slides and a link to the recording as well. I'll be joined today by a number of speakers, including AJ Bell's Investment Director, Russ Mould, Lisa Webster, our Technical Guru, and Ryan Hughes, Head of Investment Partnerships at AJ Bell Investments. We also have a guest speaker from Canada Life, which is Technical Specialist, Julia Peake. For now, I'll kick off the session with a business update and what's been going on here at AJ Bell Invest Centre. For those that are new in the room at the session today, I thought it would be good to cover off who we are here at AJ Bell. Giving you a little bit of background on the business, we now look after business on behalf of 440,000 different clients. That amounts to £64.1 billion worth of investments, which we have under administration as well. In terms of scale, we are the fourth largest on the platform side, but for 2022, we were actually the second fastest growing platform for the last quarter. So it shows that something that we're doing is right, being well received by advisors as well. Just a bit touch on there, member of the London Stock Exchange, and now we've got over 1,100 staff working out of both our Manchester and London offices as well. Looking at our snapshot of our latest annual results, these came out in December, just before the end of 2022. Number of retail customers, steady organic growth, up 15%. Assets under administration was slightly down, but I think that was the same across the whole market, given what was going on last year. Revenue was up 12%, and profit before tax was up 6% as well. If I was to kind of take that data back over the past 5 or 6 years, you would see strong organic growth, which we've done here at AJ Bell. We're not in the business of acquiring other platforms. It's purely working with independent financial advisors, and it's a nice, strong kind of bell curve in terms of growth, which we've had. For this session today, I thought it would be relevant to link it into Consumer Duty. It's something that a lot of advisors will have been preparing for, will have heard over the past few months, especially in the run-up to the deadline of July. There are 4 kind of key pillars of Consumer Duty. One is products and services, second, price and value, then we have consumer understanding and consumer support as well. I'm going to break each of those pillars down and we'll look into them a little bit closer. So the first one being products and services. At AJ Bell, we're very prominent on not just advisors being able to look after specific accounts with ourselves. As such, we have a wide array of wraps, which we'll cover off shortly, because we know it's very important for intergenerational planning. Wealth is going to be passed down from one generation to the next, and advisor firms need to prepare for that. And what better way than being able to support all of a family's clients on one platform? Let's have a recap on some of the different accounts which we have. So we have the SIP and retirement investment account, 2 different variants of our pension, RAA more geared at the lower end, but we'll cover off the charges a little bit later, and SIP at the higher end. We have the ISA, stocks and shares ISA, which is fully flexible. We have general investment accounts, be that in different trust forms, so bear trusts, for examples. You can have designated accounts, charity accounts, limited company accounts, you kind of name it, you can go where you want with that product. We also look after the junior SIP, junior ISA products, again, just being able to have all of those under one roof. We also now look after offshore bonds on behalf of Canada Life, who are here with us today, and Utmost and Quilter International as well. There is one product that's not on there, which is the Lifetime ISA, which has also recently been added to our suite. How do we back up the reps which we look after? So the Funds and Shares Service is our stockbroking platform. As part of that stockbroking platform, you get full open architecture in terms of an investment universe. There are more than 4,000 different funds, unit trusts, OICs, which are available across all products. You get access to exchange traded funds, investment trusts, direct shares, any of which on a recognised HMRC exchange, which covers a lot of the overseas ones as well, and also different kind of bond investment, which you can enter into. So we cover a wide scale of the market, however complex or however simple your client needs are, we can support them. Backing that up as well, advisors can run on an advisory basis, creating their own portfolios, using multi-asset solutions. They can also outsource to MPS providers. Our third-party MPS venue has been growing. As you can see, a lot of the names that are on the board at the minute. AJ Bell Investments is our own internal range, which Brian will be covering off shortly. We've been running that now for over 5 years, so we've got the track record there, and the uptake has been fantastic. With that, we're over 3 billion, quickly approaching the 4 billion barrier. In terms of some of the other partners that we've got, a lot of the big names which you'll be familiar with, 8am, Brewing Dolphin, we have Brooks Macdonald, Charles Stanley, Vestra, Tatton, just to name a few of those guys. And we constantly keep an eye on other managers which are out there. If IFAs are needing them, we will look to add them, provided it's commercial for ourselves. Just having a very quick look at our investment range, just showing the choice which is on offer. So we run 6 different MPS portfolios on the growth side, then we have 2 on the income side. We also have 6 multi-asset funds and 2 income funds as well. There are actually 24 different MPSs, because we run them across a lot of different strategies, which I'll cover off in a minute. But that's the amount of portfolios which we run. Risk profile to a lot of the big ATRs which are out there, so Dynamic Planner, eValue, Phenometrica, Synaptics, De facto, and Oxford Risk on there as well. Price and value. We'll start with the retirement investment account, because it's one of our newer accounts. This was a product exercise which we undertook here at AJ Bell. Our SIP was more cost effective for larger accounts, namely accumulation clients over 200k and drawdown clients over 350k. As such, we brought in an all-in charge product, namely the retirement investment account, which gives you full access to the Funds and Shares Service, be it advisory models, be it third-party MPS, for you to administer an investment process for a client. In terms of charges, 0.25% all in up to 500k. That then tiers after 500k, but at that point you would be preferable using the SIP product anyway. No charges for account setup, transfers in, drawdown, online dealing, such as that. The other products are SIP, as I mentioned. This follows the normal charging structure of our platform, 0.2% up to £1 million. That then tiers to 15 basis points to 1.5, then 10 basis points to 2 million, and we cap at that point. It's more competitive after 200k because we waive our administration fees for drawdown clients after around 350k, taking into consideration the drawdown fee. ISA, GIA, and the rest of our investment products that we have on the platform, that follows exactly the same charging structure, but there are no other additional charges in relation to that. Both these products tier together, so if a client has a SIP, an ISA, GIA, all under the same name, they tier from a charging perspective. Right to the costs of the MPS and the fund range. As I mentioned before, there are 6 growth, 2 income orientated, but turns that into 24 on the MPS side, just because of the different implementation styles. The funds we run with a fee cap at 0.31%. The MPSs range just depending on implementation style. The one fixed thing across all of those investment ranges is that we take a 15 basis point annual management charge. It doesn't change for different styles. The increase in charges is based on the blend of the different investments which are being used under there. So, for example, we'll take a quick look at the balanced MPS, 0.28 OCF, inclusive of our 15 basis point AMC and 13 basis point OCF of the underlying instruments in there. Consumer understanding and consumer support I've put together because they're kind of quite similar. We'll start that off with a bit of a platform user leaderboard from Platform, big independent surveyors of the market. We generally get really good feedback from our IFAs who use us on that basis. As you can see here, we've come out 5th in this position. P1 True Potential are new at the top in there, but from the bigger platforms, we're always in the top 2-3 kind of positions. We get good feedback for BDM support, which I always say is down to myself. But we've got a great team supporting IFAs on a national basis. Also, from a fee perspective and from ease of doing business with ourselves as well. We speak to a lot of advisors who use a lot of the big insurance companies, and one of their main gripes is being able to speak to someone in a short period of time. Our advisor support team back up the platform to support clients and advisors alongside the business development team. But they're a great team and they have really strong SLAs. 93% of calls are picked up within 20 seconds. Some stats on here about how many calls we're taking on an annual basis. We get really good feedback from the advisor support team. Advisor always say it's fantastic that we can speak to someone without having to send an email or sit on a waiting line for half an hour, 40 minutes to get through. Technical expertise as well, we can also back that up on that side. We started off in 1995 as a SIP and SaaS provider. We've got a lot of the old technical guys who used to work here at that time as well. You may have seen many of them. So, for example, Lisa on the road quite frequently. You'll be seeing her today on this webinar as well. Martin's our internal technical manager. He helps field questions with IFAs. Laura, Tom, Leif, Russ, you tend to see frequently in the trade press, on the BBC, different publications relating to the financial services sector. So those guys are here to support you. We do bi-weekly webinars online with technical content. You can also get access through to the technical team, through the business development team. If you need any help with any specific queries, we're more than happy to assist with that. Another team to mention as well, which doesn't get spoken about enough, is our platform support team. We do a lot of migrations here at AJ Bell, in that we have a specific team which are able to support with that. So if there are firms who are interested in moving big assets from a specific platform to ourselves, we can sit down with a firm, with the platform support team and the business development guys to work out what the best approach would be. We'd go through an asset approval process. We generally find a higher up manager at the seeding scheme, so we can lean on them to make it a smooth transition in moving that across. And again, migration processes are agreed with each firm before at the outset, and we will work that out with the firm to move the assets across. Just to recap you guys on the business development structure, Alison is the head of South Sales. She looks after the Southeast North, Southeast South and Southwest. I'm the business development manager for the Southeast North. I have Jack who supports me. We have Neil and Mark on the key account side, and we also have Brian who's just joined us on the distribution side for the investment business as well, who you'll hear from a little bit later today. I just wanted to thank you for letting me run through that. Again, if there are any questions, please add them into the chat box at the end, or if you want to add them, if you want to contact me directly or any of the team, we'll be more than happy to field that. Here to set the scene today on investment markets. Dusting off his crystal ball to look at what we can expect in the coming months. Up next is Russ Mould, Investment Director for AJO.
Hello, I'm Ross Mould, AJ Bell's Investment Director, and in this short 15 to 20 minute presentation, we're going to look at pauses, pivots, and policy pickles, and the implications of all three for financial markets in 2023 and beyond. As I'm sure you're aware, in the past few days of the farrago involving Silicon Valley Bank, well, that's all related to this, and that's not me banging my own trumpet, but it is the sort of thing that we've been worrying about possibly coming out of the undergrowth for some time. So these are the topics that are going to very quickly whiz through. 2022, we'll park that as quickly as we can. 2023, then we'll look at what's changed, the biggest issue of all, how you can track the implications of that biggest issue and what's developing, and finally, perhaps a few hopefully helpful conclusions. So 2022, well, again, the less said, the better. Whether it was war, whether it was climate change, whether it was political chaos, labor unrest, rising interest rates, or good old-fashioned allegations of fraud in the bottom right-hand corner with Sam Bankman-Fried, 2022 was not necessarily a year that will live in the memory for all of the right reasons. And from an investment point of view, unless you and your clients were long commodities, it was frankly really pretty tough sledding. As we can see from this chart here, looking at capital return in local currency terms, it was commodities first, the rest nowhere. Natural gas, oil, commodities, the Bloomberg Index in general, and gold all held their own pretty much. Corporate bonds, high yield bonds, and government bonds struggled. Equities struggled even more, and Bitcoin was, well, almost fell off the chart here on the right-hand side as risk appetite ebbed in the face of a process of price discovery in terms of what indeed now is the correct cost of money, given that it certainly wasn't zero, which is where central banks have been holding it for some time. And looking at just zooming in into equities more specifically, there were some gainers. They were hard to find. Brazil, India, and the much maligned FTSE 100 managed to stay in positive territory in local currency terms. The biggest fallers were some of the previous lockdown darlings, rather like Bitcoin, with Nasdaq there, a very heavy faller on the right-hand side, and Europe struggling under the weight of higher energy prices there in the middle. However, until Silicon Valley Bank, at least, 2023 had a bit of a better feel for it. And intriguingly, everything that had worked so well in 2022 would stop working, and everything that had gone wrong in 2022 started working again, or at least to some degree, in a big flip round of sentiment. So Bitcoin's had a great run. Equities had managed a bit of a gain. You'd seen, all right, gold sort of holding its ground in the middle, but commodities had actually been the underperformers. And in equity terms, last year's winners, Brazil and India, now this year's losers over to the right-hand side. And last year's big losers, things like America, for example, and to a degree the Europeans, they're some of the leading gains, with China noticeable there in the middle as it begins to unfurl after a lengthy period of lockdown. Hopes there for improved economic activity, giving the Shanghai Composite a long-awaited lift, and the same to a degree for Hong Kong's Hang Seng Index. So what's changed? Well, first of all, let's face it, valuations got cheaper. So, there were heavy falls, particularly from sort of February to October last year. There was then a big rally at the end of the year, but in the end, valuations got cheaper. And I think it was therefore tempting to argue or start to wonder whether, to some degree at least, a recession had been priced in. We got a break in the fact that oil and gas prices started going up, stopped going up and started going down. That has helped take some of the sting out of inflation. And we've actually had some slightly more optimistic commentary on economic growth, both from talking heads at Davos and central banks, but also some of the macroeconomic statistics actually haven't looked too bad. And central banks, while at the same time acknowledging perhaps the economy has been a bit stronger than thought, you have seen a deceleration in the pace of rate rises. The Federal Reserve's last rate rise was just a quarter point. It had been a half before that, and the previous 3 or 4 meetings had all been 3/4 point increases. So that's sort of allowed markets since October to think, okay, maybe we're through the worst in inflation. Maybe the rate will begin to decelerate. Okay, maybe we're going to get a soft landing, or in some cases, some people have even been arguing for no landing at all, and would actually avoid a recession altogether. And yet, despite that, markets are still thinking, okay, we'll get a cooling inflation, we'll get an economy that hangs in there but isn't clearly going gangbusters, and that might allow central banks to complete a fabulous hat trick here and actually put in a peak in interest rates and even start to cut them. So that was the treble that was hoped for, the hat trick that was hoped for, that helped spark the rally from October. deceleration in inflation, no landing, or certainly a soft one, and a peak in interest rates. And markets understandably are praying for a pause and a pivot in monetary policy, because we got 367 interest rate increases in 2022 against just 18 cuts. We've had something like another 40 so far this year, according to cbrates.com, against just a handful of cuts. And the cuts have come from those who have been genuinely struggling. Turkey because of the earthquake, and also it's got some unusual political situation with a presidential election this year. China because of lockdowns. Russia because of its fall from favour with the international community after the war on Ukraine. And some of its satellite states as well have been leading cutters, but they're generally speaking not countries that will be bothering you or your clients particularly. So markets clearly feed off cheap money. They love cheap money, and they're praying for its return. And we can see here why. This is the bars are the aggregate balance sheets in dollars of the big 5 central banks who have been most active users of quantitative easing: Bank of England, Bank of Japan, European Central Bank, Swiss National Bank, and the US Federal Reserve. And as you can see, their balance sheets have broadly gone up by 60% since the start of the pandemic. And since the great financial crisis, they've more or less quintupled. But as we can also see here, the rate of growth has begun to decelerate. And as the Fed, the European Central Bank, and the Bank of England have begun to embrace quantitative tightening to various degrees and try and withdraw some of that stimulus, we've actually seen the balance sheet start to shrink. Now, it therefore may or may not be a coincidence that is why we've seen greater volatility in some equity indices over the last 18 months. This is just looking at the FTSE All World Index against that aggregate central bank balance sheet. You could argue there's a bit of a fit there, whether we may need to look at the debate separately of correlation or causation, but nevertheless, it does seem to be an intriguing coincidence. And again, it wouldn't be a greatest bit of surprise if we were to see a little bit more volatility going forwards if central banks stay the course. And I guess that's one of the key questions now in the wake of Silicon Valley Bank. So what are the cases for and against a pause or a pivot, or indeed in favour of further interest rate increases? Well, in terms of further interest rate increases, why would central banks look to further tighten policy after what may well be the fastest round of rate increases ever? Well, China, the world's second biggest economy, is reopening. That it could start to gobble up, considerable quantities of raw materials, which may be self-inflationary. You can argue that deglobalization is inflationary. If we are looking to indeed employ more people in Wolverhampton or Wisconsin rather than Vietnam, with the best will in the world, those British and American workers will be more expensive. So the goods and services they provide will be more expensive. Although, again, the employment benefits you would like to think would be considerable. It's easy to make a case for energy prices being underpinned here. Yes, natural gas has come down a long way, but oil has held firm at around $80 a barrel. OPEC's got a lot to do with that. But also, if we do avoid a deep recession, then that should be pretty helpful for energy demand. Energy demand is still growing. At the moment, renewable energy isn't really suitable for base load requirements. It can be a little bit variable. And our addiction to hydrocarbons could be hard to kick, and that could be a problem, because in the end, we've been, for good environmental reasons, telling oil companies not to knock holes in the Earth's crust, so they haven't been doing so. So supply hasn't been growing, demand certainly has been, and it is indeed possible, as China reopens, that we get a little bit of a squeeze in oil prices, though intriguingly, it's not happened yet. Labour, I put there, well, strikes. We've seen some whacking wage increases in Germany, Japan, and we've seen some in the UK as well. Wage growth is still running at sort of 5 to 6% overall, higher for the private sector, I admit, rather than the public sector. And war generally is inherently inflationary. It fractures supply chains. It forces people to even redeploy industry in great cases. It can lead people to go off to war and shrink the labour force in extreme examples. Hopefully none of those bad things will come to pass. But generally speaking, war is inflationary. What would give the central banks a chance to pause on interest rate increases or pivot? Well, government austerity, fiscal probity is in theory going to slow economies down, and that may take some of the steam out of things. A recession certainly you would expect, as it would be knocking consumer and corporate investment and confidence and therefore spending. A mild winter has been extremely helpful. If you could just look out of the window now, it's not too bad here in Brighton today. And that would certainly, again, take some of the heat out of energy prices, and has done so. And Europe's also done a good job of establishing storage, and it's also done a particularly good job of actually cutting its consumption. Politics. This is a tricky one, and we all know central banks are independent, even if their chairs are political appointees. And what I would say here is that if you're a politician, there's inflation out there, you're going to be unpopular, of course, because people will be frustrated because they're worse off. But if they lose their job, they're an awful lot worse off still. And so therefore, from a politician's point of view, unemployment is the bigger evil of the two. So if you had to take your chances with one, they'll probably take their chances with inflation. And then debt. This is a big issue, and we just discovered this in a microcosm with Silicon Valley Bank. Higher interest rates put the pressure on corporations and consumers. Silicon Valley Bank's customers were burning cash. They needed liquidity. They couldn't float because stock markets were largely shut to them. They began to draw down their money from SVB. SVB didn't have the liquidity to cover that. And that's where the run on the bank started, and things began to spiral from there. So debt is inherently deflationary, disinflationary, and central banks will want to try and keep a lid on the cost of servicing it, because otherwise that will create some severe problems indeed, potentially. And this is, I would argue, the biggest issue of all of this, still lurking in the background. The grey line here is the total issuance in aggregate of total US debt securities, or total outstanding at any given time. And as you can see, since Nixon took America off the gold standard in 1972, it's basically gone up in a straight line at varying rates of speed. The only time it shrank very briefly, where that circle is, that's the great financial crisis. So that tiny, tiny, tiny reduction in global indebtedness contributed to a heart attack from which the global economy really found it pretty hard to recover. Do you really think that grey line is going to start coming down? No. So that, I would suspect, in the end, will put a cap on interest rates at some stage. The Fed still hasn't, no central bank that I'm aware of, certainly in the West of the majors, has got interest rates back to where they were before great financial crisis, because the increased indebtedness in the interim means that the impact on the economy is huge. Mr. Sunak has said, 1 point on gilt rates is 25 billion pounds of interest. In the US, it's there's a similar calculation here with America's $31 trillion of debt. America's tax income is about $3 trillion a year. There's already 700 or 800 billion of that going on tax on interest servicing, and that's really before interest rates have started going up. The UK has 850 billion or so in tax receipts. Already it's paying about 80 billion in interest. That's not a healthy situation. And if rates go up much further, and also once they start rolling over debt at high rates, that is really, really, really going to put the squeeze on. So this is the biggest issue of all. It probably does put a cap on interest rates at some stage, even if right now central banks are espousing their inflation busting virtues. And why does this matter? Well, in the end, the hit to economic activity would be potentially substantial as government interest bills rise, but also we're talking about the price of money, which has been zero effectively for 10 or 15 years, and that's why people have done dumb things with it, as Silicon Valley Bank has proven, taking on substantial amounts of risk in terms of the customers, ending up with a mismatch between assets and liabilities, not managing its liquidity properly because it never thought there would be a possibility of rate rises or a serious accident. So when money is cheap, people do daft things with it. Now, when money has a cost, they may have to treat it with more respect. And that's why we've seen corrections in things like monkey JPEGs, Bitcoin, meme stocks, and some of the more speculative areas, because there's an opportunity cost now to doing things with silly things with money. So this is why this really, really matters for two reasons. One, the cost of debt, and two, the benchmark of which all assets are relatively priced. And we can see here's the US 10-year Treasury yield against the FTSE All World. That sharp run up there in bond yields, it's definitely had an impact, you could argue, over the FTSE All World. So what do we do? How do we track this? Well, what's uncanny is that if you look at the UK 2-year gilt in the top left-hand corner and the top half, and the US 2-year yield on the Treasuries in the bottom half, they generally move 6 to 9 months before their respective central banks do. Markets can be smart. They're not always right, but their views must be respected. Now, clearly, it's therefore tempting to argue, well, you could do away with the Fed and the Bank of England altogether and save ourselves some taxpayers' money. That isn't viable, because there's bound to be some toe rag in the investment bank who will gerrymander and jig and fiddle about with the 2-year yield, just as there are allegations that people did that with LIBOR. So we've probably stuck with the central bankers, well-intended, smart, but ultimately human, and therefore ultimately prone to error. But it's probably better than having somebody intentionally rigging something. But keep a look on the 2-year yields, because they will give you a much better feel ultimately than the central bank doublespeak as to where rates are going from here. And right now, they're actually hanging in a little bit below where rates actually are officially. So the bond market is kind of calling the central bankers bluff. They're talking hard on inflation, but the bond market isn't convinced. And if you look at the US yield curve, where normally the 10-year yield is higher than the 2-year yield because of the extra risk, and therefore investors demand extra compensation and extra yield to compensate for that time element. It's at its most inverted since 1980-81, when the US suffered 2 deep recessions in pretty quick territory. So the bond market is convinced there's a recession coming. The equity markets have convinced themselves there's going to be a soft landing or no recession at all, or at least until they did recently. So you would think on balance, one of them is going to be wrong. Now, finally, this is perhaps the ultimate test case for what we're talking about here in terms of debt. The Bank of Japan has been running quantitative easing since the early 1990s, and a zero interest rate policy likewise. So it is the daddy, as it were. It's the longest standing user of these unorthodox policy tools. Every time it tried to withdraw them, either the economy's rolled over or inflation has popped up a little, and inflation has only popped up briefly. So it's never really been able to sustainably extract itself or extricate itself from those policies, and it's having a devil of a job doing it now. In fact, as you can see here, the yen began to collapse late last year. So as the central bank continued to print money to buy bonds to suppress the interest rates, it had to make a choice. Keep on printing and crush the currency, or stop printing, support the currency, but then let bond yields rise. And the Bank of Japan blinked. The bond vigilantes had their wicked way with the Bank of Japan for the first time, probably since the 1980s. The Bank of Japan raised its 10-year JGB yield ceiling from 0.2 to 0.5%, and it went there in an instant, and battle lines are now drawn again. We have a new bank coming in, he's got his hands full. If Japan starts to withdraw quantitative easing, you would expect bond yields to rise, which would be very bad for the Japanese economy. If it keeps on printing, the Japanese yen could come under further pressure, and that's inflationary. Rock, hard place is a phrase that springs to mind, and Western central banks will be watching this with extreme interest because they might find themselves in a similar pickle. So, conclusions. Markets are still trying to work out whether we've got inflation, stagflation, or deflation coming. Right now, they've taken a benign view of the world, even though we've just had the most bizarre 2 or 3 years, enormous amounts of fiscal and monetary stimulus. They've gone for a painful Goldilocks exit from this of gentle deceleration in inflation, no hard landing, a nice soft landing, and a pivot in interest rates. What if it happens? Fantastic. Everybody will be extremely pleased. But that's kind of assuming that we're returning to the time that we've had for the last 20 or 30 years, and that just feels perhaps a little bit too convenient. Debt is certainly boxing in central banks, and because they can only take money so far, cost of money so far, but nevertheless, there is a suspicion that they've now got a very, very difficult job taking us exactly between inflation on one hand and recession on the other. And any diversion from that, well, you're likely to see volatility in asset prices of the type that we've seen recently. It may just be that we are seeing an end to a 40-year era of cheap capital, cheap goods, cheap labor, and cheap services, cheap energy. Capital had its wicked way with labor for 40 years. Labor had its wicked way with capital for 40 years before that. You do get these occasional changes in cycles. I'm reluctant to say it's different this time because you're normally wrong when you do, but maybe we are on the cusp of a major change. And if that's the case, then what's worked asset-wise for the last 20 or 30 years, long duration assets like bonds, like tech stocks, biotech, might not work as well if that's the case. And shorter duration cyclical value assets and hard assets rather than paper assets might be the solution if we are indeed seeing that sea change. Now, how can you judge that? Well, we won't worry too much about gold because it'll upset Kevin Duran, our head of investments. But this is the chart on the top looks at the S&P 500 against the Bloomberg Commodity Index. And if the chart's going up, then commodities are outperforming. If the chart's going down, then equities are outperforming. Commodities are about as cheap relative to equities as they've ever been. And they went up pretty strongly when there was a sense that central banks were losing control in the early 2000s. And again, gold is just as cheap relative to the S&P 500. So if the era of cheap money, cheap debt, cheap energy, cheap goods, cheap labor is over, then you might perhaps expect commodities to start to show a little bit of a wiggle on if history's any guide. If we go back to Goldilocks in the 2010s, low rates, low inflation, low growth sludge, sure, long duration in excelsis, but it may be, just maybe, we're on a bit at the cusp of a little bit of a change, and this chart will hopefully help you spot it if so. So thank you very much for your time, everybody. I greatly appreciate it, and hopefully we look forward to we'll be able to see each other in person again on another On the Road session very, very soon. Thank you.
Thank you, Russ. Any questions you may have, please put these into the chat box or complete on the feedback that will automatically load at the end of this webinar. Next up is guest speaker Julia Peake with her session, Tax Planning with Bonds post the autumn statement. To help you navigate potential higher tax bills for your clients following the autumn statement, This session will address the various features and benefits that offshore bonds bring for both individual and trustee clients.
Hello, welcome to today's webinar. My name is Julia Peake. I'm one of the Canada Life technical team. And what we'll be discussing today is tax planning with investment bonds post the autumn statement. So your learning objectives for today: by the end of this session, you'll be able to comprehend the changes of the capital gains tax and dividend allowance in light of what was announced in the autumn statement and how this relates to fulfilling your consumer duty requirements. We'll also be looking at some features and benefits of investment bonds and why that might be suitable for certain types of clients. And then just to conclude, we'll look at some other factors that we might want to consider when we're building a holistic financial plan. So to kick off, let's start with capital gains tax. We know that when the new tax year rolls around, that the capital gains tax exemption is actually going to drop. Currently, it's £12,300 for tax year 22-23, but that's reducing down to £6,000 by tax year 23-24, and then down to £3,000 by tax year 24-25. Now, this is for individuals, and what this means for a lot of clients is we're going to have less exemptions to play with, and or clients are going to be paying more tax. If we think about the types of clients we work with, there might be some clients who use better and ISA facilitations. We might have clients who are selling investment properties, or we might have clients who are actively trading. So these exemptions are going to get used up much quicker because we've got less to play with. And while we're thinking about the types of clients we're dealing with, we also need to consider our trustee clients. Now, trustee clients get half of what an individual gets. So for this tax year, it's actually £6,150. But that will depend on how many settlements a settler has created. So if they've created up to 5, then that annual exempt amount can actually be split up to a maximum of 5. And if we think about what is going to happen over the new 2 tax years and that reduction coming in, it means that for trustee clients, we're actually going to be looking at £3,000 maximum in the new tax year. And then by tax year 24-25, £1,500. And again, these can all be split up to a maximum of 5. So again, there's going to be less to play with, and potentially trustees are going to have to be paying more tax. We also need to think about gifting and disposals. We know that gifting between spouses and registered civil partners is exempt for capital gains tax purposes. But if we're looking to gift assets which are subject to capital gains tax to any other persons, that's going to count as a disposal. And as we've already discussed, with less to play with, it could mean that we might be able to have to restrict what we actually give away and or pay more tax for it. Let's just have a look at a quick example about how it works for a discretionary trust going forward. We've got Mr. Jones here, and he's got a discretionary trust that he set up in May of 2017. Bought a portfolio of shares for 200,000. The value is now 265,000. What you can see here over the next 3 tax years is the gain minus the trust allowance and that reduction that comes in. So for this tax year, because they've only set up 1 trust, it's 6,150. And you can see here that the tax payable at trustee rates of 20% is £11,770. In the new tax year, that tax rises to £12,400 and rises again by tax year 24-25 to £12,700. Now, what that means for a lot of clients is, while there's an increase in tax, and that might be from a monetary point of view, not very much, from a consumer duty point of view, that's actually an increase of just under 8% in tax. What I'm saying here is we don't necessarily have to make a lot of changes here, but we do have to have a discussion with our clients, because under the cross-cutting rules, when consumer duty comes in July of this year, we need to make sure that we are acting in good faith. We need to make sure that we avoid causing foreseeable harm to our clients, and we need to make sure that we're acting so that clients can achieve their financial objectives. An increase in taxation might actually hinder that. So while I'm not saying that we have to make massive changes to a lot of our investments, we do have to have the conversation, and then the decision has to be made. Another change that's came in, that's coming in the new tax year, which was announced in the autumn statement, was the reduction in the dividend allowance. So We know that dividends have been played around with since 2016, where we lost our 10% credit, and we had that introduction of the £5,000 allowance. And then in 2018, it got reduced down to £2,000. As you can see here, moving through to the new 2 tax years, so moving through to tax year 23-24, that dividend allowance is going to reduce down to £1,000 and then down to £500 by tax year 24-25. So again, we need to think about the types of clients we're dealing with here, where income for dividends actually comes in the income tax calculation, and also what other sources of income we have here. We also need to consider our trustee clients, because trustees don't have a dividend allowance here. This is only for individuals. Currently, trustees have a standard rate band. That first £1,000 worth of income, which is taxed as if it's basic rate. So if it was a dividend income, it would be taxed at 8.75. But what we saw in the spring budget that was announced was actually by April of 2024, there's going to be changes in relation to discretionary trusts, where they're going to introduce a nil rate band of £500 for low income trusts. And they're actually going to get rid of that standard rate band. We're waiting for more information and for this to be put into the draft legislation, but that's something that we need to be aware of when we're dealing with discretionary trustees and going forward, especially when that comes in tax year of 2024. With this reduction in the dividend allowance, thinking about our individual clients though, we need to think where that dividend income actually sits in an income tax calculation. And unfortunately, even though we've gone through an extraordinarily high period of inflation, the taxation system really doesn't care. The taxation system cares about how much money is going into your bank account. And while we have seen wage rises go up, they haven't been keeping pace with inflation because of it's been so high. People have been getting 4, 5, 6% pay rises. We also need to consider the fact that the Bank of England have put up their base rate for the first time in a very long time, and that's currently at 4%, which was decided by the Monetary Policy Committee a few weeks ago. Dividend income comes in after your non-savings and after your non-savings income and after your savings income. So it comes in, which comes in much later. So more clients are going to be paying more tax and potentially at higher rates because we're seeing those increase in wages and that increase in bank interest. What that means for a lot of clients also is that more clients are going to be potentially having to report this income via self-assessment tax returns. There's more administration that might be involved, so potentially more time and potentially more costs for clients as well, especially if they're not going to do their tax returns themselves. If we have a look here at this table on the 4% yielding portfolio, currently a £50,000 collective investment scheme or portfolio of shares, if it's £50,000 and below, then your £2,000 allowance actually covers the income that's being produced or accumulated. When it rolls through with these reductions coming through over the new 2 tax years, you can see the value drops that the allowance will cover for that income, £25,000 in the new tax year and then £12,500 by tax year 24-25. That's not even enough to actually fulfill your ISA subscription for that tax year. So just to be mindful, we need to be having conversations with these clients because this is going to impact many different clients, especially those which have got those unwrapped portfolios. I mentioned about the order of taxation and why it's important. If we think about where that dividend income fits in, we know that first into any income tax calculation is your non-savings, non-dividend income. So that's things like your salary, your self-employed earnings, rental income, pension income, and your personal allowance there is used in the most tax efficient way. So used here to offset against this source of income first. Second in is your savings income, and that's things such as interest from your bank and building society accounts, corporate bonds, but also importantly here, gains made from insurance policies without a tax credit, so your offshore bonds. Now, gains from investment bonds are counted as savings income, but where they fit in an income tax calculation actually differs. Offshore bonds come in at number 2. Dividend income comes in at number 3, and as I've already said, because of that allowance being reduced, more people are going to pay more of their income at higher rates going forward because there's going to be less allowance to play with. Redundancy payments after £30,000 comes in at 4, and then you get your gains from life assurance policies with a tax credit, so your onshore bonds come in at number 5. Now this is important when we're considering different clients that we're working with, their sources of income, and if we're trying to take money out of bonds, where that might fit in compared to what other income they are earning. So we've spoken a little bit about the taxation changes and why that's important and why we need to speak to those types of clients, because they are going to potentially be paying more tax and at higher rates going forward. But let's just have a look at some features and benefits of why investment bonds might be an appropriate solution. If we think about an investment bond and how it's structured, we know that the legal and beneficial owner of those assets is the life company. So if you make any changes to the underlying portfolio, then it's actually a fund switch. Investment bonds aren't subject to capital gains tax unless they are a second-hand policy. They're subject to the chargeable event regime and chargeable to income tax. Lots of investment bonds now are made up of thousands of individual policies, and we refer to this as segmentation. And that's beneficial for a couple of reasons. One, it allows you to do an assignment by way of gift, and that tax-efficient gifting. So if I was to assign my bond to my children, that is a gift from me to them. And so long as I don't get anything back and it's not done for money or money's worth, then it's a gift and it's a potentially exempt transfer from an IHT point of view, but it also does not trigger a chargeable event. If I was doing it for money or money's worth, it would trigger a chargeable event there. But also from a segmentation piece, if you've got thousands of individual segments, then the gain per segment when you do a full surrender calculation means that it's going to be much less. So you could be more pinpoint accurate when you're looking to withdraw money out, and you could do it in the most tax efficient way. And if you're working with tax allowances, such as your personal allowance, personal savings allowance, and that savings rate band for income tax, the first £5,000, which is taxed at 0, then you can be working with that and be more pinpoint accurate when you're trying to withdraw money from a bond. If we're thinking about investment bonds and how they're set up, we know that they are non-income producing assets, so they make great trust investments, because from a trustee point of view, there's no ongoing reporting requirement unless there's a chargeable event. And also, if we're looking to register them under the trust registration service, it will go under as a reportable trust unless the trustees are paying the taxation on them, on the bonds. We also know that we can have 5% of the amount we've invested cumulatively rolled up over time over a 20-year period. That 5% tax deferred withdrawal facilities that's on investment bonds is a return of capital, so it's not income, so it doesn't interfere with any other income tax that you might actually be having to pay because it's return of capital. There's also certain reliefs that are available, such as top slicing relief, time apportionment relief, and deficiency relief that you could use to offset against some of the tax that might be due on gains. And if we're thinking about offshore bonds in particular, you have a choice of jurisdiction about where you want to set that bond up. So for example, Isle of Man or Dublin or Luxembourg or Jersey or Guernsey. If you're thinking about which type of clients you're working with, just by way of example, if you're working with clients who use DFMs, then under the Tax Consolidation Act of 2010, if you have an Irish domicile bond, then DFMs don't actually pay VAT on their DFM fee, so you save the clients a little bit of money there. You've also, looking at offshore bonds, got the choice between additional lives assured or a capital redemption policy. If we're thinking about it from a provider taxation point of view, you can have an onshore bond or you can have an offshore bond. An onshore bond means that you pay tax within the fund. And if you're a basic rate taxpayer or can assign to a basic rate taxpayer, then and you remain so upon a chargeable event, there's no further tax that's needs to be due on that. If you're thinking offshore bonds, you get that benefit of growth roll up over time. There might be some withholding taxes to pay depending on where you're invested, which are non-reclaimable. But in the main, that fund will go tax-free, which is a benefit to a client, especially if you're holding it for a long time. If we're thinking about some of the features and benefits for collectives, we know that if you make a loss on a disposal of a capital gains tax asset, then if you register that with HMRC within 4 years, then you can carry that loss forward indefinitely to offset against future gains, which is a real benefit. The tax rates which are chargeable for capital gains tax is 10 or 20%, and we haven't seen any changes in that. So it's much less than paying 20, 40 or 45%, which is your income tax rates. We know that capital gains tax dies on death. So the person inheriting that asset, the base cost is the value on the date of that person's death. But just be mindful, just because you save on capital gains tax, unless that asset is held in a trust, that asset could be inside the estate and subject to IHT depending on the other assets you hold. So if we're thinking about target market and from a consumer duty point of view, your typical client for an onshore bond is wanting a UK provider, be subject to UK regulation, be subject to the UK financial compensation scheme. It's going to be a UK resident throughout the policy term. And as I said, either going to be a basic rate taxpayer or have that ability to assign to a basic rate taxpayer so that you can have that credit when the chargeable gain occurs. People who have maximised their ISAs and pensions, so we saw in the spring budget that there's changes to pensions that are coming in the new tax year. The annual allowance is going up to £60,000. You're going to have different types of clients that you work with, and some people will be able to maximise those £60,000 on an annual basis, but you'll also have clients who can't. Some clients are starting off in their career who maybe only have their UK relevant earnings of 30, 40, £50,000, but they're also of an age where they're getting inheritances from family members and they're looking for investment solutions that they could use. So potentially ISAs, potentially investment bonds here because of some of those features and benefits that we've just discussed. The fact that there's not going to be a lifetime allowance limit going forward as well means that pensions is going to be looking a lot more attractive to those higher net worth clients. And remember, pensions are one of the best family trusts that we've got. We're looking at clients here who are investing over the medium to long term. We're also looking at clients who have utilised their allowances and their exemptions. Clients who want that tax efficient withdrawals, that 5%, being allowed to switch and change that underlying investment without a tax consequence, and that gifting. And those people who wanting to use trusts from an IHT planning point of view, but also because of the administration and reporting requirements are much less than if you are holding unwrapped assets. If we're thinking offshore bonds, as I said before, we get that benefit of gross roll-up over time, but your typical client here as well is looking for an increased investment opportunity. So working with platforms, working with DFMs, working with model portfolios, potentially looking at different currency options as well. Again, they've maximised their ISAs and pensions where appropriate to do so, because ISAs will be subject to inheritance tax unless they're held in business relief assets such as an AIM portfolio, which is good for some clients, but because of their high risk nature, they might not be suitable for a lot of our clients. So it has to be suitable. The tax tail can't wag that investment dog. We're looking at clients who want to invest over the long term. We're looking at clients, again, who have utilised their allowances and their exemptions, and they're looking for that tax efficient withdrawal, switching, gifting, and looking to use trusts. If we're thinking about target market for collectives, we're looking at clients who want to take advantage of those lower rates, as I've already explained, at 10 or 20%. Utilising those capital gains tax exemptions and those dividend allowance. So we don't get much from HM Treasury, so we should utilise everything that we have available to us to build that holistic financial plan. For joint investments, if you're working with spouses or registered civil partners, if you can equalise the assets, you can make use of both capital gains tax exemptions. And remember, there is that startup exemption there. But also by doing that as well, especially if you have a disparity in the different taxpayers. So for example, if one spouse is an additional rate taxpayer, one is a basic rate taxpayer, if you equalise the assets, then you could potentially increase that household income. We're thinking about clients who want to use their ISA subscription and that bed and ISA facilitation on an ongoing basis as well, where it's suitable to do so. And importantly, if we are looking at these unwrapped portfolios, then those clients who are willing to take on those reporting requirements, either as individuals or as trustees. We said before about why segmentation is really important, and that you could be really pinpoint accurate when you're trying to withdraw money from an investment bond. If we take this example here, where there's been an original investment of 300,000, and over a 15-year period, we've assumed a 4% annual growth net of all charges. So the value of the bond is now £540,280. I mentioned before about the allowances available we have to play with. So we have our personal allowance of 12,570. We've got a personal savings allowance if you're a non-taxpayer or a basic rate taxpayer of £1,000, or £500 if you're a higher rate taxpayer. Additional rate taxpayers don't get a personal savings allowance. But you also get that standard starting rate band for savings income, which is the first £5,000 taxed at 0%. So potentially, if you're working with a non-taxpayer or the ability to assign to a non-taxpayer, you've got £18,570 to play with. So if you have this original investment of 300,000, and let's say that for those older style bonds that you might still be working with, there was 10 segments. What you can see here in the gain per segment column is the gain after 15 years is over £24,000. So if you were trying to assign one segment out to a non-taxpayer here, and for them to encash in their own name, you wouldn't be able to do so without them paying tax. If you compare that to 100 policies where the gain per segment is £2,402.80, you'd be able to assign 7 segments. You do the full surrender calculation, which means that they would yield £37,820, and the chargeable gain would be £16,819.60. 1,000 segments, a lot of industry standard here. Gain per segment is £240.28. You could take 77 segments, assign those, they could encash in their name. They could gain 41,601 and a gain of 18,501. But if you can split it up to 99,999, look at the gain per segment, it's £2.40. So 7,737 segments, £41,779. But look how close that gain is to the allowable allowances here. It's really, really close. And so you can be more pinpoint accurate when you're actually trying to withdraw money out, and be really targeted when you do so. I said before about investment bonds being good assets for trusts, and there is going to be a type of trust available for the different types of clients you're working with. From probate trust to gift and loan trust, flexible reversionary trust, discounted gift trust, controlled access trust, and those outright gifts to the trustees. A conversation will have to be had with those clients as to what access they need, whether or not they need income or withdrawals. And let's not forget about pensions. Those changes mean that as pensions are really tax efficient and they sit under a master discretionary trust in a lot of cases, they're a really great family trust. And with that lifetime allowance being removed, it could make them more attractive as well. But for certain types of trusts that we work with, only an investment bond would be a suitable solution here. If you think about a discounted gift trust or a flexible reversionary trust, collectives wouldn't be a suitable asset to be held in there. But potentially for other types of trusts, it might be, but remember those reporting requirements that the trustees would have for any income that's either taken or accumulated within that fund. And just before we conclude, just some other final points to consider when we're looking to build a holistic financial plan for our clients. We need to consider the time horizon for the investments, what that family dynamic is. Can we use spousal exemptions? Who's benefiting from this money? Is it the children, grandchildren? Is it a corporate investment? How actively are they looking to manage that money? Are they going to be trading a lot? If so, do we might want to take advantage of that fund switching benefit that investment bonds have? Are the allowances or exemptions being used elsewhere? Have they already been used, or are they targeted to be used going forward into the new tax years, especially with those reductions coming in? We also need to consider what the tax position is for the client, and if that's likely to change in the future. We know because the additional rate tax threshold is coming down in the new tax year down to 125,140 from £150,000, there's going to be an additional about 125,000 people who are currently paying higher rate tax, which are going to fall into additional rate tax in that new tax year. Is that likely to change when they're looking to withdraw money out or appoint money out? Can they assign money out to somebody who's a non-taxpayer? And while tax is really important, it's not that sole factor. And I go back to consumer duty on this. The tax tail shouldn't wag the investment dog. The investment needs to be suitable, and we do need to consider risk and capacity for loss. And while there might be more investment opportunities available out there which might achieve an IHT saving quicker, such as VCTs and EISs, it has to be suitable for the client. And some of those can be high risk. So that needs to be a consideration when we're building this holistic financial plan. The bedrock of which pensions, ISAs, general investment accounts and investment bonds and trust planning, there is going to be different amounts that you put in there for different clients depending on their circumstances. But that is your bedrock, and that's where we can really add value to clients, is taking all of this information and applying it specifically to the clients that are sat in front of us. From a Canada Life point of view, we do have a mixture of investment solutions that are available to you. We have our offshore bonds, which are based in the Isle of Man or in Ireland, and that's our Premier account. We also have our flexible reversionary trust, our wealth preservation account, again in the Isle of Man and Ireland. If you want to know anything a little bit more about that, please speak to your regional account managers. We also have links to the AJ Bell platform, so you can use AJ Bell as your investment engine. We have a wide range of standalone trusts which are available on either a discretionary or an absolute basis to wrap around those different types of bonds as well. And just by way of support, on our Canada Life website, we have a wide range of materials, investment solutions, briefing notes, webinars, articles covering a wide range of tax and estate planning subjects, but also pensions as well. We also have a professional trust service that we are working with. If you want to know a little bit more about that, again, please speak to your account managers. And you have us at the technical team as well, who, if you really want to, you can drop us an email onto our ICANN technical team, and we can respond normally within 24 to 48 hours if you have any technical questions with regards to any of our products and service. And that just reminds me to say thank you very much for your time today. I hope you found it informative. All of this information is given to you, and it is intended for professional advisors only. Please be aware that there are subject to changes and there is new legislation coming out, and past performance is no guide to the future.
Thank you, Julia. Again, any questions for Julia, or if you'd like to know more about products from Canada Life, please note this on the feedback form at the end of the session or in the chat function. Next up is Head of Investment Partnerships, Ryan Hughes. I'm sure you'll have seen Ryan presenting out at our in-person sessions, and he's here today to decipher if bonds are back in business following a tricky 2022. Will things improve for the coming year? Over to you, Ryan.
Hello there, my name is Ryan Hughes and I'm Head of Investment Partnerships at AJ Bell. Delighted to talk to you today all about fixed interest, with the title of the presentation, Are Bonds Back in Business? The first time that I've had to present on fixed interest for quite a while, because it's been a topic that really hasn't been a lot to talk about, but I think there is now. So let's crack straight on and see what we could go through. Just a quick agenda we're going to run through today over the next 20-25 minutes. I'll give you a quick update on AJ Bell investments, and I will also then try and talk to you about Henry VIII and how that relates to modern day QE and fixed interest. And then I'll do a brief run through of what went wrong in 2022 in fixed interest, and try and touch on, are things different today? And in which case, how have we had to adjust the AJ Bell portfolios, both the funds and the MPS, to cater for what could be quite a different and changing environment. So let's look just very briefly at an AJ Bell Investments update. I know lots of you have supported the AJ Bell investment solutions. We're very, very grateful for that. So thank you for your support. As you can see on the screen here, our assets have been growing nice and steadily, and we've gone through the 3 billion mark on the team across our range of products. And we're very, very grateful for you for supporting our investments and putting your clients' hard-earned money with us. We never forget whose money it is. We're also growing the team out there as the assets are growing to make sure that we can keep delivering the great service that so far you've been receiving from us over the last few years. So there's new additions to the team, and we hope there'll be more during the course of this year as well. I think also what I really like about the way that we manage the investment solutions is this commitment to keep reducing costs. And that is a genuine commitment that we've been giving to the market for all the time we've been operating these investments now, well over 5 years. And when I launched the funds right back in 2017, as it was then, we launched the funds, the AJ Bell funds, with an OCF of 50 basis points, and now they're right down at 31 basis points. So you can see that as we've grown, as our AUM has grown, as that chart shows, we've been able to pass on the benefits of those scale to investors and drive down the cost of investing, something that we're absolutely committed to keep on doing. Delighted to win a Citywire Investment Performance Award for 2022. Really, hopefully a good validation of the performance that our solutions have delivered, not just last year, but actually for numerous years before that as well. And we'll look at that in a little while. And also continuing to widen out the availability on other platforms that we have. And so we are expanding the offering and continue to do so. So if you'd like to see the AJ Bell Investment Solutions on other platforms, then do please get in touch, because very often this is driven by demand. And the more demand that we know of, the more we can put pressure on those other platforms to give access to you via all those different platforms that are out there, of which of course there are very many these days. So let's track straight onto the meat of the presentation, which is all about Henry VIII and modern day QE. And you're probably thinking, how are these two related? What's Henry VIII got to do with QE? But I think to do that, I probably need to take you back on a little history lesson. And what you can see on the screen there is a picture of Henry VIII, of course, and then 3 other gentlemen that you will recognise as two previous and 1 current governor of the Bank of England. Now, what have they got in common? I hear you ask yourself as you look at this slide. Well, if we think about Henry VIII, then he had a reputation for spending a lot of money. And he actually inherited a fantastic fortune from his father, which was £375 million in today's money, a huge amount of money. Never needed to worry about inheritance tax planning. Obviously, he wrote the laws of the day, so no need to worry about all of those taxes and trusts that we get stuck into today. But the trouble with Henry VIII is he loved spending that money, and he particularly loved spending that money on war. He went to war in many different countries, particularly France. You can see a map of France over my shoulder there, due to me having a French wife. So Henry VIII was certainly warring with my wife's ancestors, as it was back then in the 1500s, but he also was warring with the Roman Empire and indeed the Scottish, many wars with the Scots up there in the north of Britain, and these wars were ruinously expensive. And Henry VIII ran out of money. In fact, he didn't actually have enough money to do all the things he wanted to do for his 6 wives, his wars and his palaces and all of those things. He ended up actually running out of money. But the very good news for Henry VIII was that he actually controlled the Royal Mint. The Royal Mint was based in the Tower of London, and in that Tower of London, he tasked the Royal Mint with making some more money. And now, in those days, your coins were made out of gold and silver, and therefore you needed a plentiful supply of gold and silver to make those coins. But the trouble is that England didn't really have any money because Henry VIII had spent it. So he had to find a new way of coming up with some additional money. And what he tasked the Royal Mint to do in the Tower of London was actually mix some copper in with his gold and silver to effectively make it cheaper to create new money, and that in that way he could finance those things he was spending his money on. And that actually went reasonably well in the mid 1500s for a couple of years, as he was producing all of this extra money, and it was finding its way into circulation, and the merchants were using it to trade with our trading partners overseas and so on. And it all was going well until the Flemish merchants, who were doing a lot of trade with Britain at the time, realized that the coins that they were getting didn't seem quite right. Now, we will all know that when we get a brand new coin from the Royal Mint today, it's lovely and shiny, it's got nice sharp edges, a very clear image of the monarch of the time. I haven't actually seen one of the new king yet, but it won't be long before we see those in circulation. But it was exactly the same with the coins of the day. When they were newly minted, they looked absolutely fantastic. But we know that as our coins pass through our various hands, as we spend those coins and they touch all the different people over the years, that those coins become slightly tarnished. And what the Flemish merchants found was that those coins were actually, the silver on the coin, on the face of Henry VIII, was actually starting to rub off. And what they saw underneath was not something they were very happy about, which is they realized that some copper had been mixed in with the coins, and effectively Henry VIII had embarked on some kind of medieval QE. He'd started to devalue the pound there, and he was doing that by mixing more and more copper in with the gold and silver. And actually, where it started rubbing off on those coins was the most prominent part of his face on the coins, which of course was his nose. So Henry VIII is known as Old Copper Nose because of the fact that his nose was a very copper-coloured nose on those coins as they passed through the hands of the Flemish merchants. But of course, he devalued sterling and found his way to some kind of medieval QE. Now, if we look at actually what he did there, if we look back in history, and we can see in the 1520s, a coin was, this is before he embarked on this process, which was known as the Great Debasement. A coin actually had about 92% silver in it. But in the 1540s, when he started the Great Debasement, he'd actually managed to cut the amount of silver in his coin to around half, actually. And then just a couple of years later, when he was still needing to make even more money, then he'd cut that to a third. So a really significant devaluation of the pound as it was there. And to say those Flemish merchants suddenly realized that actually they needed more pounds from the traders to buy the goods from them. The pound had been devalued, and therefore it wasn't worth as much, and therefore they wanted more in return. All sounds very, very reasonable, and probably all sounds a little bit familiar too. But let's look at what the Great Debasement, what it did to the English economy of the day in terms of inflation, because this is where I think it gets really interesting, and we can learn a lesson from that medieval QE from where we are today. The Bank of England has some amazing statistics on its website that go back a very, very long time, and I've managed to dig out these statistics from the Bank of England website, giving us inflation data back in the 1500s. So we really are looking a long way back in time. Now, 3 bars on this chart. The first bar actually includes a portrait of the young Henry VIII. I'm not sure many of us would recognize that portrait. We're much more familiar with him in the picture we've got in the middle there. But you can see in that very first bar that for a very long period of his early reign, that inflation actually was under control, was very, very low, at around that 1.5% mark, and it's remained stable for a very long period of time. But you can see that middle bar when those Flemish traders realized that the flood of money had entered circulation and that money had been created effectively out of nothing. It wasn't the value of that money wasn't anywhere near as big as it should have been, just as we're seeing today, that we saw inflation in medieval England shoot up to 6.7% for a period of 7 years. Now that is about 4 to 5 times higher than they had seen in England for the preceding 40 to 50 years. So it really was a very, very big sea change as this flood of money had hit the economy and devalued the pound. Now, it was only after Henry VIII's death that the subsequent monarchs realized that they needed to regain England's standing in the world as a trading nation, and to do that, they needed to put the the silver standard back, to take it back to 92.5% and take this copper out of coins. And to do that, they had to take the excess money out of the system there and melt it down and separate out the copper and use the gold and silver to make more coins. But in doing that process, which actually took a very long period of time, it took the best part of 50 years, it was actually quite successful. And you can see that for the 50 years after the Great Debasement, that inflation actually reduced quite substantially and was back down to a level of more like 0.7%. So hopefully that little quick snapshot in the history of Henry VIII and the Great Debasement and medieval QE, you're probably sitting there thinking, some of this sounds quite familiar. And it sounds familiar for a very, very good reason. So let's bring it right up to date and think about where it all went wrong in 2022. So Western governments have gone full Henry VIII. They have spent the best part of the last 15 years creating money. We saw medieval QE in the Tower of London. We've then seen the modern day QE in the Bank of England, where it's now a computer that makes the money rather than the coin presses of the day. But the chart on this slide shows just UK government debt and just how much it has increased since 2008, since the financial crisis, on a consistently upward trend, and then an acceleration of that trend as we reach the COVID pandemic and Western governments unleashed a flood of monetary support into these economies. So as we unleash this wave of money, just like Henry VIII saw, to me it seems very, very logical as to why we've got a period of high inflation like we have now, which is we've had too much money chasing too few goods. Now it's a very, very convenient reason to point all of the blame at Russia and high energy prices for why we've got this high inflation. But this kind of wall of money that was coming behind was already, we'd seen asset price inflation before that. Long before that, most asset classes have gone up and hit record highs at various points over the last few years. And of course, you've seen things like Bitcoin and art and horse prices and all those types of things that have all gone through the roof at various stages over the last few years. As this flood of money has to find a home to go somewhere, and people want to put it to work. So we've got this wall of money that's gone into the economy, and now quite rightly, investors are demanding a higher expected return from those investments if they're prepared to lend money to governments and companies. It seems perfectly rational that the risk has increased and therefore they want a higher return. And as a result of that, their confidence has taken a very, very big hit from the confidence in central banks has taken a very big hit as it's harder and harder to trust what they say, and the fear of devaluation continues, even if it's devaluation by stealth rather than a very, very overt devaluation. So because of all of that, interest rates have had to rise sharply during 2022. And again, that doesn't really come as too much as a surprise to us because the trend was there, the wall of money was there. This is not a new phenomenon. This unleashing of QE, we'd say we're talking about a 15-year period in history that was going on. And so rates have had to go up to entice more and more investors to lend money to governments and countries. So let's look at actual performance. Well, bonds had a terrible year in 2022. I think many of you will be aware of that. In fact, it was the worst year for US Treasuries for 125 years there. So we really are going back a very long time in history since we've seen a period as bad as this. On this slide, in the top left-hand side is a chart of different parts of the bond market with two different coloured bars. We've got the blue bars there, which represent the return of different parts of the bond market in sterling, and we've got the red bars that represent different parts of the bond market in local currency there. Now, what we can see is that sterling devalued during 2022, and therefore, actually, if you were owning overseas bonds, you had some insulation from the very worst of it. But let's not sugarcoat this. This was a particularly difficult year, pretty much wherever you were in whatever asset class you were in. Gilts off close to 25%, index-linked bonds losing a third of their value, despite a period when inflation is very high, which I guess we get lots and lots of questions about why index-linked bonds have not performed well in the period of high inflation, and that's all to do with where the real interest rate is, which is still not appealing. there. So it really has been a very, very challenging period for bonds, and particularly in the UK, where our economy is essentially funded by overseas borrowers. It's not really the UK investor that's lending money to UK governments to finance all of our spending. A lot of it comes from overseas. On the bottom right-hand corner there, you can see an annual return of the UK gilt market over the last, well, nearly 40 years there. And you can see far and away, this is the worst year that the UK gilts have had in that period. In fact, there are only, where are we, 1, 2, 3, 4, 5, 6 down years in that entire period. The previous worst year was 1993, just after the pound crashed out to ERM. So again, perhaps we can see that devaluing your currency is not a great strategy if you want to have good returns for fixed interest. Just a final point to make on this slide here is the inflexible nature of the 60-40 strategy. Now, lots has been written about 60-40 strategy, but last year it suffered, and it was very much a case of being inflexible. Its lack of flexibility that stopped it delivering. So they don't have the ability to shorten duration. They don't have the ability to change credit quality because they're beholden to the index there, and therefore that level of lack of flexibility really hampered them in the way that we operate our own strategies. We have a huge amount of flexibility to adjust the portfolio to the market conditions we are in. So is it different this time? We spent a lot of time there looking at history. How is it different now? Well, interest rates have repriced. Over 350 interest rate rises during 2022 around the world, and you can see on the chart here the 10-year gilt yield, just how quickly the interest rates have risen, and therefore, of course, bond yields have risen alongside that. Now, it's very much the case that for me, that it wasn't the fact that rates have repriced that should have been a surprise. It's the speed of the repricing that has caught the market out, and that's why we've seen the level of volatility that we have. I think it was fairly clear. Well, it was fairly clear to us that interest rates had to go up. After all, they've been at record lows for the best part of a decade. And unless you're a believer in negative interest rates, then it's highly likely that rates were only going to go up. The key was really, what's the catalyst? What's going to drive them up? And of course, Ukraine and energy prices and so on have had an element of being an element of the catalyst in that, but it's not just that's really been driving that. It is that wall of money behind that's been ultimately pushing those rates higher. So the key question now is, where do rates peak? What is the terminal rate? That's the phrase that is known, where interest rates peak in the cycle, because just about all assets are priced off the bond yield, and until the market gains some confidence as to where interest rates and therefore bond yields are likely to peak, it's very hard to price some assets with certainty out there. Now, I think there is some good news on the horizon. You will have been reading and hearing over the last few weeks that it seems like inflation may well have peaked, and if we've had inflation peaking, then we should be close to having interest rates peaking as well. Now, of course, we've seen in the run up to the end of 2022 and indeed into 2023, we've seen equities and bonds rally quite hard. In fact, the gilt market's up about 15 to 20% from its lows back in September. So it really is quite a big move in the gilt market over quite a short period of time. And that is all to do with the noises coming out of central banks that they think rates might be closer to peaking than we thought at the back end of last year. But I think we also need to be cautious. These assets are not rallying because we all think the world is fixed and that central banks have done their job and all is well with the world and the economy again. I think a lot of this is to do with short covering. It's all of those investors that were betting on rates going higher than the market expected and inflation staying higher than the market expected. And now they're thinking that's not the case. Well, they better close out those shorts and buy back those assets. And that's been driving asset prices higher. So I think it is right to maybe just tread a little bit carefully and have an element of caution in terms of what we've seen over the last 8 weeks with the way asset prices have rallied. But there are definitely positive signs out there, and we should be encouraged by that, particularly with where rates are, and that's what we'll look at right now. So where are rates today? Well, this chart here is the dot plot. The dot plot comes out from the Federal Reserve after every meeting, and you can see the straight line of dots there at the end of the year. This is when the Fed put out their dot plot for the end of the year. You can see where the interest rates were, and that each dot represents a voting member of the Federal Reserve. Now, across the chart, we can see it goes to 2023, 24, 25 and beyond, and the dots start getting wider and wider as each voting member of the Fed becomes less and less certain as to where interest rates will go during 24 and 25. But I think what we can see is, as we look through to 24 and 25, that rates start to appear that they're likely to go lower. Now in 23, currently, the dot plot's telling us that they expected rates to go higher. Since they did this dot plot, we've had one rate rise, and in fact, the Fed's telling us that there might be some more relatively soon. But that's all priced into markets. That's not new information. We know all of that, and that's why bonds have sold off as they have, and yields have gone up. But what's much more interesting to us is what's happening, what's likely and potentially going to happen in 24 and 25. And as you can see here, the consensus among voting members of the Fed is that interest rates should fall. And as we know, falling interest rates is a positive story for bond prices. So this is why, another one of the reasons why we've seen the bond market rally, because the bond market and indeed the equity market, they're not focusing on the here and now. The here and now is in the price. What they're interested in is 12 months down the line, 18 months down the line, and what's going to happen then. And if they're seeing that they think interest rates are going to be lower, then of course they're going to be wanting to buy bonds today to benefit from those cut-in rates in 24 and 25. Now this dot plot here is pricing in a rate cut of about 2% by 2025, which would be quite material, be beneficial for bonds. So I think there's a lot to think about out of the dot plot there, and it's a really useful thing to Google and look at every time there's a Fed meeting and see how things have changed. So thinking about our portfolios and thinking about bond markets, it's worth just looking at where yields are, and these are slightly out of date, only a little bit out of date from when we were updating our asset allocation in January. And I've got here the inputs of different parts of the bond market in terms of what the yields have been as we've approached the end of each of these years, 2020 through to 2023, what the yields been on different bits of the market there on either the 10-year gilt or the corporate bond index and so on. Now you can see here that there has been a significant repricing of interest rate risk there, of bond prices. We can get a yield of about 3.5% on a UK 10-year gilt today, compared to about 0.9% just 12 months ago. The bit that gets me really interested is actually investment grade corporate bonds, because when we cut this data, they were offering a yield of nearly 6%. Now it's a little bit down from that now, because as I say, they've rallied off their lows, but a yield of 6% on an investment grade bond where the default risk is incredibly low as judged by history, that to me sounds quite appealing, particularly when we have those expectations that inflation should fall back. Now inflation is a rolling 12-month number, and so we've got the very steep increase in energy prices from 12 months ago falling out of the calculation, and therefore very naturally we've actually got, it's not almost a guess, we know in the way that it's calculated that inflation will fall as those numbers come out of the back end of the calculation. So we get inflation falling below 5.9%, and we can buy investment grade bonds that are yielding more than that inflation rate. Then we're able to start generating a real return from fixed interest, which sounds really, really appealing. It's not just global investment grade, it's high yield too. We've got high yield at over 9% here. Again, it's come off a little bit since I put this slide together, but high yield is yielding more like equity levels of return. And EMD too. Yes, of course, there are risks with EMD, but risk and investment is all about ensuring you're being compensated for the risk. What we've seen in this chart when we look at the previous years is you weren't being compensated for the risk historically, and it feels to us like 2023 is a very, very different picture. So how have we navigated that? How have we been positioned, and what have we done to adjust as the world has changed around us? Well, just looking back a little bit in history, I've taken data here from our balance strategy over the last 5 years, two different pieces of information on here. The first chart Each one of these slices represents a duration bucket, and if we start at the top in blue, then that's a very, very short duration, and as we go down there, it gets longer and longer duration. Over the past 5 years, we've been really, really worried about rising interest rates and what had to happen in the bond market, because rates just felt to us like they were just too low. They had to increase, but we weren't sure when. But as that wasn't really materializing, we wanted to protect the portfolios more and more. And so over those 5 years, we took our short duration position from around half the portfolio of the element of fixed interest, that is, to more like 2/3 there. Now, what we knew by it being short duration is that if we were right, we would manage to protect capital in the portfolios. And if we were wrong, we would make just less money than people that were longer duration than we were. And that sounded like a pretty good position to be in when rates are at record lows and we feel like they really can only go one way. So we've been increasing our exposure to short duration as we went through the last few years. The bottom bit of this chart is all about credit quality. And again, starting with the blue, we can see that's the highest credit quality in the market, those AAA bonds. And if we go down and down and down and down, then we get to below investment grade there. Again, what you can see, particularly around the start of 2020, was that we significantly increased our exposure to the highest quality bonds, AAA bonds, bonds issued by the US government in dollars there, because that gave us very natural diversification and also a great hedge in the portfolio. If things got really ugly, we would expect the dollar to rally, and indeed we would expect that element of bonds of credit quality to also outperform the investment grade, the US Treasury bonds to outperform corporate bonds and high yield and so on. So we increased our exposure to the highest quality bonds, that is A+ there, from about 30% of the fixed interest element to around half. Now, of course, that was history. That was for an environment where rates were incredibly low, where it was hard to see where you could generate a really good return from fixed interest. But as I've just been explaining in the previous slide, it feels like the world has changed and we need to adapt the portfolios to counter that. So what have we done in the portfolios just recently? Just in January, actually, as we updated the funds and the MPS strategies. Well, perhaps unsurprisingly, if you've listened to the last 20 minutes of this, we've increased our exposure to fixed interest by between about 3 and 9%, depending on which portfolio you are in. Now, we've marginally increased duration, just a little bit, by about half a year. The yield curve remains very flat, if not inverted, actually a little bit. And that means that if you're lending money to a government or a company over a longer period of time, you're not actually getting increased returns for the extra duration of the time of that loan there. So if you're buying a bond from an investment grade company, whether you're buying that bond that's got a 2-year life, a 5-year life, a 10-year or a 20-year, we're actually roughly offering you the same amount of return. But of course, we know the risk of lending money to a company on a 20-year basis is very different to a 2-year basis, because we should have much more confidence that in 2 years' time that business will be there to pay us back, compared to the uncertainty of 20 years. So we don't want to add too much duration. What we have done is certainly changed credit quality. As you could see in my slide a couple of slides ago, the yield available on investment grade bonds versus government bonds looks very, very appealing. And therefore we've made a reasonable size shift from those government bonds into investment grade bonds to try and lock in that higher yield, that higher potential return. So that's meant selling out of some of those US treasuries and buying investment grade corporate bonds around the world there and getting that yield pickup. Now, we've also increased high yield there, and I know that immediately some people may think, well, that sounds incredibly risky, but it's important to understand where we funded that move from. And really that's been funded from equity. And again, if we think 2 slides ago, I was showing that high yield is offering returns on that side of 9%, but it's certainly between 7 and 9% at the moment. And if we think back in history, well, the equity markets offered us a return of about between 7 and 8%. If we look at long-term, over 100 years of data, that's what equities have done. What we're seeing today is that high yield bonds are offering equity-like returns, but of course, high yield doesn't carry the same amount of risk as an equity. If we buy the equity and it goes bust, we get wiped out. We get nothing back. If you buy the high yield bond and the company goes bust, there is a recovery rate there, and you should get some of your money back. So therefore, if we can get an equity-like return, but for lower risk, that feels like a good move for the portfolios. And so that's exactly what we've done in moving some of that money into high yield, again, last month when we made those changes. Now, those of you that have used our strategies over the last couple of years will know that we've had some explicit inflation protection in the portfolios. While inflation is now, say, rolling off, and our US tips, which is what we're owning, we've sold those down and locked in the profits on those as the outlook for inflation feels somewhat different today. So just going to bring that together and think about the expected return on the overall portfolios as we update these on an annual basis. Some of you would have seen this chart before, so slightly busy, a little bit going on. I'll just explain it briefly. So the triangle in the middle there of each of those bars is the expected return for each of the portfolios based on the expected return of the underlying assets, because that's part of our inputs, and therefore we can get an expected return on the output. So if we use the balance strategy as an example, which is the number 3 there, then that's got an expected return of 7.5% per annum. Now the bars around that are how we would expect those returns to look across a multi-year horizon. So 80 years out of 100, we would expect the return of that same balance strategy to be between -5 and +21%. 20 years out of 100, it'll be outside of that range. Might be on the up, might be on the down, and of course 2022, when we've seen such a year where bonds have their worst year for over 120 years, it shouldn't be much of a surprise to imagine that a lot of those returns were around that kind of bottom tier of that bar. But if you're doing cash flow modeling and planning, then hopefully this type of information is useful for you when you're mapping out your clients' cash flow planning for the next 10 or 20 years. So just want to touch on performance, just very, very briefly. This is a traditional way of looking at performance. We're very, very proud of these performance numbers. These are the AJ Bell funds, but the NPS is essentially a mirror of that. They're particularly proud of the Cautious Fund being first in its IA sector over 5 years. It's been really, really challenging running cautious portfolios, as you've just seen in terms of how bad bonds have been. So to be able to navigate that and be top of the sector is something we're very, very proud of. And then it's true really when you look across the board of the range there, that they've all got exceptional long-term numbers there. But I also want to look at performance in a slightly different way there, which is just showing you the quartile rankings over the last 5 discrete years. Now, something in common with 2022 was 2018, where which was another negative year. Now, in both instances, the portfolios and the NPS have proven to be very, very robust. And that's helped by the embedded diversification, by the flexibility that I talked about, being able to be short duration, being able to adjust your credit quality in those portfolios. Obviously, I've talked today about fixed interest, but there's been lots of things going on in the equity market as well, and the equity positioning that we've done. But the nice consistency of those numbers by year for us is something we are very proud of. 2020, it's worth just noting there, obviously there are a few third quartiles. 2020 was a positive year for markets. So yes, they were third quartile, these strategies, but they made good, positive, absolute returns there. And if we can get that return profile where we're doing a very good job on the downside and managing to keep up on the upside, that's a great way of compounding wealth over time. After all, the easiest way to make money in the long run is not lose it in the short run. And that's exactly the performance profile that we've seen over the last 5 years of the AJ Bell funds and strategies. So let's bring all of that together. We talked a lot, we've looked at history, we thought about Henry VIII, about money creation, about how that links to modern day QE. There's a lot going on in all of that, and hopefully that's a useful kind of just a thought process really of thinking, okay, perhaps we shouldn't be so surprised about inflation and where it is today. But 2022 was really a standout year in a bad way for fixed interest, as the culmination of so many events came together. COVID, see the terrible war in Ukraine, the wall of money that's been flooding into markets since the financial crisis in 2008. So it's a long process that's got us to that terrible year. But it shouldn't have been a surprise. It seemed clear that interest rates had to go up, and it seemed clear that inflation had to rise. And we have the flexibility in the portfolio to be able to adapt to that and position for that and benefit from it. But it's a very different world today, and we've had to adjust and change the portfolios again to make sure that we're well positioned for the world we're going in, not just the world we're coming from. The one we're going into may well be higher rates than we've seen over the last decade and higher inflation than we've seen over the last decade as well. And it pretty much means that you might want a slightly different portfolio to prosper from that than the one that did well over the last 10 years. So long-term performance remains strong. We're very grateful for all of your support for those who've given it over the years and in helping us grow. We hope you've been pleased with the returns thus far, but we never rest on our laurels. There's much more to do, and we continue to drive down that cost of investing and try and get those funds and those models, those MPS service, as low cost as we possibly can to keep driving that performance forward. So thank you very much for listening. As ever, if you have any questions or queries, then do reach out to your normal AJ Bell representative. They'd be delighted to hear from you. And of course, we would too in the investment team if you want to talk in more detail about anything I've spoken about today or anything going on in the portfolios. So I'll just leave it there and look forward to speaking to you again very, very soon. Thanks very much for listening.
pleased to welcome our Investment Business Development Manager, Brian Donald. He's making his debut today for our Off the Road series, and I'm sure you'll see him out and about on the road too. He's here today with an update on our investment range, including recent performance. Over to you, Brian.
My name is Brian Donald. I'm the Investments BDM for the South region here at AJ Bell. For today's event, we're going to be going through a brief update of everything that's been going on at AJ Bell Investments, and I'm going to be going through an overview of our core investments proposition. So let's get started. So AJ Bell Investments, we're the investment arm of AJ Bell. And we've been running now since 2016. So importantly, we can demonstrate a 5-year track record on a number of our solutions. In addition, we've recently gone through the 3 billion barrier. So a big thank you to all the advisors who supported us in getting to that milestone. If you look at what happened in the last year, we have seen impressive growth, and we were highlighted in the Next Wealth NPS comparison report 2022 as one of the leading assets growers against a backdrop of falling AUM amongst DFMs generally. Now, rest assured, with the growth trajectory that we've been on, we have been investing in the team to ensure that our solutions remain well supported. We recently hired another fund manager, and we've been recruiting at all levels of the organisation. We do continue to make cost control a priority, and getting to the 3 billion AUM, we get further economies of scale as we grow, and we will look to pass those savings on in terms of reduced investment costs for clients wherever possible. Performance has been strong, and we've been very competitive in the peer group. That's been recognised independently of late, with us winning a couple of awards. In 2022, we won Best Overall Medium-Sized Firm at the Citywire Investment Performance Awards. And then just recently, in the Advisor Choice Awards, we won the award for the most satisfactory investment outcome. And that was particularly satisfying to pick up an award voted for by the advisor community. So thank you again to all the advisors that voted for us. And then finally, just on the platform availability, although this is an AJ Bell Invest Centre event, I just wanted to mention that we are widening the availability on third-party platforms as well. So you'll be able to access our NPS in a variety of different places. We've just recently added it to Transact, and we'll continue to widen the availability because we understand that advisors may be running more than one platform, and there's a desire to have a consistent CIP. So moving on to our core investment range now and an overview of that. We offer a range of well-diversified multi-asset portfolios. These are in two groups. We have our growth range and we have our income range. Now, the first thing to say about all of our portfolios is that they are actively managed at the asset allocation level. And then we have different choices around how the portfolios are implemented. So if we start with the growth range, we go down the route of risk-targeted portfolios. And our starting point is the distribution technology dynamic planner risk scale. So we manage the portfolios to the volatility bands of these different DT risk profiles. And we have a portfolio for each of the middle 6 risk profiles. So DT3 through to DT8 lines up nicely with our MPS 1 through to MPS 6. And then, as I say, we have different choices around implementation. So we start with the passive MPS, So that's implemented using passive instruments, so passive funds, ETFs. Then we have the active MPS, which is done using predominantly active funds. And then sitting in the middle, we have our passive MPS, and that is a blended range of portfolios, combining some of the cost control benefits of passive with the performance potential of active. We've also got our responsible MPS, and finally we have our growth fund range, which provides a very similar set of portfolios to the passive MPS, but in a single fund structure. And there's lots of interest I'm finding in the fund range at the moment, particularly in relation to GIAs, with the extra bit of control around CGT management that you can get using a multi-asset fund within an unwrapped environment. So that gives us a total of 5 implementations and 30 portfolios. And then we also have a responsible growth fund. And then on the income side, we've got our 2 strategies, income and growth. Both of these looks to produce a yield of between 3 and 5%. On the income, we are looking to maintain the capital, and on the income and growth, a little bit more risk. We're looking to grow the capital. And we have 3 different ways of doing that. We have our passive MPS, we have the active MPS, and then we have the funds. So that gives us a total of 6 income portfolios. And as I say, just to reiterate, all of our portfolios are actively managed at the asset allocation level. What that then gives us is these different price points for each of the solutions. For the fund, we go down the route of having a fixed OCF. So on the growth funds, that is 0.31%. On the income, it's 0.65. And we take our management fee out of that OCF. And then on the MPS side, we have a flat EMC of 0.15. Doesn't matter which you choose, whether that's passive, active, pactive or responsible. The EMC is always 0.15, and that's included in the figures that you can see on the screen just now. And then adding in the transaction costs to give you the total cost of owning the portfolio. And then just to finish off, some performance numbers. What we've got here are the growth funds. So we've got 1, 3 and 5 year performance for the 6 growth funds. They've all been running for 5 years, except the global growth, which is just coming up to 5 years. And what you can see here is the absolute ranking within the IA sector. And you'll notice that all of these results are top quartile results. We have an array of top quartile results, which really demonstrates the competitiveness of our performance in the peer group. So that was everything from me for today. I hope that was useful, and I hope you enjoy the rest of the sessions. And thank you for watching.
Our final speaker for today may be last, but is definitely not least. A firm favourite of our tour, and if you've not seen Lisa already, in person or offline, where have you been? This very useful session is her famous technical roundup, where Lisa will shed light on industry news and look at what regulatory changes are coming down the line from the FCA and how these can impact you and your clients. Keeping you updated on the key technical issues you need to know about is Lisa.
So hello and welcome to my technical roundup session. On the agenda today, then, I've got to start off by going through some of the tax changes we've had recently, a few of those, and then I'm going to cover and update the latest of what's been going on at the FCA, and I'll finish off with a bit of other industry news, bits and pieces from round and about. So starting off with tax changes then. So we did these roadshows, physically going out around the country in February time. So obviously then I was talking, a lot about the things that come out in the autumn statement, the changes that we're having, which are coming into play from 6th of April. I'm recording this now just after the budget. So we have some rather bigger news in pensions world, I think, that has just landed. So we had the big bombshell about the lifetime allowance. There was lots of rumours in the build up to the budget that something was going to be done about the lifetime allowance, that it was going to be dramatically increased, going back up to 1.5 million or 1.8 million, but I don't think anybody really expected it to go completely. The important thing to note on this with the lifetime allowance is that it's actually only being abolished from 6th of April 2024. Not 23. There are changes coming in from 6th of April 23, but it's not going completely. It's a two-stage process, which is really, I think, just down to the time frame. The announcements come out on the 15th of March. They can't make all the changes necessary to legislation to remove it completely by 6th of April 23. It's going to take another year to get that legislation through, make the necessary changes. What they are doing, though, is making sure there's no lifetime allowance charges from 6th of April 2023. So, if you have clients that are crystallising benefits in excess of the lifetime allowance in the 23-24 tax year, they won't have associated tax charges, lifetime allowance charges with those. You will find your providers will still be asking for information about available lifetime allowance, protections, etc., because it looks like we're still going to have to do all the reporting to HMRC in exactly the same way as we have done up until now, and still send out BCE statements and things like that. So that isn't changing. But the actual tax charge, if we work out, once we've done the calculations, if we work out at the end of it that, there is an excess, just the tax charge won't be applied. So the 25% lifetime allowance charge, when you put funds into drawdown on the excess, that's going completely from 6th of April. If you're taking a lump sum in excess of the lifetime allowance, instead of the 55% tax charge, what you'll have instead is that will be taxed at the individual's marginal rate of income tax. As I'm sat here talking now, the draft legislation of exactly how that works isn't out, so I haven't seen all the finer details on that, but are planning on doing another webinar once we have that information and we've analysed it to go through these changes in more detail. So we'll come back to you on that one. One thing to remember is sort of like the sting of the tail, if you like, with the lifetime allowance being removed, is that PCLS is going to be capped. So it's going to be capped at the current level, which is 25% of the current lifetime allowance, so it works out as £268,275. I do wish they'd made it a simple number if they're going to freeze it for years. We'll see. So, but yeah, that's the figure that's going to be the maximum figure. However, there is a caveat on that, unless it's protected. So if you've got clients that hold protection at the moment, though they won't need the protection to avoid a lifetime allowance charge in the future, they may still need that protection in order to have access to a higher tax-free amount. So, don't tear up those protection certificates just yet. We're waiting for the details on that. In terms of people with enhanced or fixed protection and making contributions, it does appear that people will be able to make contributions because they won't need to rely on those protections anymore, and they will be able to make contributions without affecting the extra tax-free cash they may be able to take. However, I will say, that's only for people that have already got the protections in place, and it'll only apply if they make contributions after 6th of April 23. So don't make contributions this tax year for those people, and really hold off doing anything until we've seen the legislation and exactly what's involved on that. But holding off for those people, they won't have contributed for a number of years anyway. The other bit of good news for them is, of course, once they can contribute, they're going to be able to put in more, because the annual allowances are all going up from the 6th of April as well. So the main annual allowance going from 40,000 to 60,000. The money purchase annual allowance is going back to its original level of £10,000. So it's been down at 4,000 for the last few years. You've probably seen in the press there's been lots of action from the industry, really pressuring particularly on the MPAA, that the 4,000 was too low. So it's good to see that's gone up to a more sensible level of £10,000. We also have changes to the tapered annual allowance. So the minimum level for anybody that's tapered will be £10,000. So that's up from the current 4,000. And the threshold where tapering kicks in is going up by 20,000. So you have to have adjusted income above £260,000 to be impacted by the taper, and to have the maximum taper applying. So your tapered annual allowance would be 10,000. Then you'd have to have income in the year, adjusted income in the year of above 360,000. So that's quite a noticeable increase as well. So yeah, basically, it looks like great news for pensions. You can all put more, everybody can put more money in, and not having to worry about the lifetime allowance going forward. Going back a little bit in time, back to the autumn statement. Obviously, the news we had then was all about freezing of allowances. So these are all, going to be happening from next tax year. So we're going to have a freeze on the personal allowance, the basic rate band for income tax, higher rate band for income tax. I should say all of that applies unless you're in Scotland, because we have different rates in Scotland for anybody north of the border, any clients who are resident north of the border. NI bands, again, NI bands for the whole of the UK are frozen. If you're not in Scotland, they are now aligned as well. The main employee thresholds for NI are aligned with the tax bands. The personal allowance and the high rate thresholds, they're aligned, the NI bands are aligned. So we had a bit of a messy year in terms of NI last year in terms of both bands and rates, but it's all kind of a bit more streamlined now. And inheritance tax has obviously been frozen the thresholds have been frozen for a number of years as well. And we know that all of those are going to be frozen until 5th of April 2028. So, we've had good news in terms of pensions, what you can put into pensions. Obviously, this is all in real terms. Tax means we're all going to be paying more tax because these thresholds are all being frozen. In real terms, that's a cut, especially with wage inflation. People are going to be moving up the tax bands as earnings increase. If these bands are frozen, everyone's going to be paying more tax as they go up the bands. Other cuts we had in the autumn statement obviously was the dividend allowance, big one, going from 2,000 2022-23 down to 1,000 next tax year, and then cut again to £500 the following year. Similarly, we have the CGT annual exempt amount being slashed from 12,300 currently down to 6,000 next tax year and 3,000 the year after. So, all of this is, incentives, even more reason than ever to get money into tax wrappers. And obviously with the increase in the allowances for pensions, they've just, given us more opportunity to get more money into pensions. And, there's even more incentive to do this to avoid, paying CGT and dividend tax on here. The other cut we had was on the additional rate threshold for income tax. So currently it kicks in the 45% rate at £150,000. that's going to go down to 125,140 from the 6th of April. Bit of an odd number, but of course that aligns with when it's like the end point for losing your personal allowance. So from 23-24 onwards, whilst all these thresholds are frozen, these are the effective rates of income tax we are going to see. And I say this, apologies to those of you north of the border, so it's a more complicated system in Scotland, but for the rest of us, this is what it looks like. So your personal allowance up to 12,570 tax-free. You've then got a basic rate band at 40%, followed by, when you get to 100,000, effective rate of income tax is going to be £60,000. So that's because you have £40,000 higher rate tax plus the removal of the personal allowance. As soon as that the removal of the personal allowance is sort of finished with at the 125,140, the tax rate then goes on to the 45% rate above that level. So we can see that these earnings between 100,000 and 125,140 is where you effectively pay the highest rate of income tax. And you're going to see, you know, more and more clients who will be tipping over that £100,000 point. You know, with wage inflation, there may be people that, you know, are under that level at the moment who might be going over it for the first time. So really, you know, it's worth, I think, a quick reminder, you know, of how pension contributions can really help with this and how you can get back that personal allowance. So if I take the example of somebody who's got £125,000 of income, at that rate, if they don't make any pension contributions, they will lose nearly all of their personal allowance. They'll just have £70 left on it there. We can see they have the full basic rate band of 37,700, and the rest of their income falls into the 40% tax band because they've not tipped over into that additional rate band yet. So the total tax bill for the year works out as 42,432. If that same individual were then going to make a pension contribution, if they made a £20,000 net personal contribution, so basically pay that into their pension, get relief at source at 20% on it, so that goes into £25,000 gross, that would give them back all of their personal allowance. So they have 12,570 tax-free. They still have the the basic rate band of 37,700. But that basic rate band is actually extended by the amount of the pension contributions, the gross amount of the pension contribution. So there's another 25,000 that falls into that basic rate band, and then just the excess after that goes into the 40% band. So you work out the tax bill at the end of the year when they're doing the self-assessment, and their tax bill now is £32,432. So they've just saved £10,000 there. Plus, of course, they've had the £5,000 tax relief within the pension. So actually, it saves a total of £15,000, and they get the 60% tax relief. Another sort of quick point on this for people who are in this bracket, people who are just tipping over the £100,000, seeing, you know, the pension contribution could be very valuable in terms of tax relief, but also if they have children, if they, at the moment, if you have a 3 or 4-year-old, you get 30 hours free childcare. If both parents are in work, or if it's a single parent and they're working, then you get those 30 hours free childcare for children in that age group. The moment you earn over £100,000, you lose it completely. So £99,000 earner, you can have 30 hours free childcare. As soon as you tip over and earn, you know, £100,001, you lose it completely. It's not a taper, it's not gradual, it's just gone. So actually, if you think about the cost of childcare, of 30 hours childcare, you know, your tax relief in effect is much higher than the 60% you get, because if you make that pension contribution, income comes back down below 100,000, you still get those 30 hours. Now, going forward, this is going to impact even more people, because we also had in the budget the announcement about the extension of the 30 hours free childcare. So it's going to be happening gradually over the next couple of years. It's going to go down to 2-year-olds, and then it's going to go all the way down to somebody that has a 9-month-old child, so starting at the end of maternity leave. It's actually maternity leave. So yeah, it's going all the way down there. So you can definitely see situations, you know, where people can easily have 2 children in their, you know, normal sort of there's a fairly average age gap for children, you know, 2 or 3 years apart. You could have a, you could have a, you know, a 1-year-old and a 3 or a 4-year-old. So, you know, potentially 60 hours between the children. That's even, you know, not accounting for people who have twins or anything like that. It would be increasingly common. So you can really see how valuable that pension contribution could be, just to nudge people back below the 100,000 in terms of income tax relief on the pension contribution, but also on their childcare as well. Going sort of back to the CGT cuts, we mentioned about that. Just a reminder, obviously using BED and ISA. So if you are sitting on gains, crystallise up to the CGT allowance this year and get it into an ISA. Now we're probably very close to tax year end when you're watching this, but also you haven't done that already, but don't forget, you can just do it again at the start of the tax year as well, because though obviously it's been slashed from the 22-23 tax year into 23-24, it gets slashed again the year after. So make sure, you know, you do it again next year. It's still better than the year after that. Spousal transfers, so you can transfer without any gain between between spouses or civil partners, and if you do that, then you can make sure you use both people's allowances. You can also offset any losses made. So if you have had a loss on disposal of assets, then you have 4 years in which to claim that loss and offset it against your gains after the tax year you disposed of the asset in question that made the loss. And then the other thing, sort of planning around CGT cuts, obviously, is the use of offshore bonds, which I'm not going to say more about because you should have just heard from Canada Life, who've talked all about that. Few other things we had from the autumn statement going in the other direction. Moving up, we had confirmation on state pension going up. We also had confirmation that child benefit is going up, like a lot of the benefits related to inflation. So it's just over 10%. September CPI figure, it is going up by. Why am I talking about that? Well, I just want to touch on really the high income child benefit charge, because this is you know, a significant issue and a growing issue as well. That we're seeing people being impacted by the high income child benefit charge. And again, you know, you'll have people who are moving up with wage inflation that, you know, weren't currently impacted by this, who then become impacted by it. Also, we're finding people that are getting impacted by high income child benefit charge that didn't realise, you know, that it covered them. So high income child benefit charge applies if an individual or their partner is in receipt of child benefit and either of them have income above £50,000. And if they both exceeded, the highest earner is the person who pays it. One thing that probably people don't always realise, it doesn't have to be your own child. If they live under the same roof as you, so for example, if you had a client and they moved in with a partner who has a child from a previous relationship, they don't have parental responsibility for them, but if they are under the same roof and their parent is claiming high income child benefit, claiming child benefit charge, and then your client ends up with £50,000, they will be liable for this charge. Say, even though it's not their child, even if it's not their child. The way it works, the charge is every £100 earned in excess of £50,000, the tax charge increases by 1%. So it means that if you earn over £60,000, the tax charge is 100%. So it's 100% of however much child benefit you get. You can opt out of child benefit, but if you do that, then NI credits are lost. So it's really important, especially, you know, if there is usually mum, but, you know, not necessarily, who's staying at home and looking after the child, they get NI credits, obviously, which help towards their state pension and other benefits, whilst they're claiming child benefit. Whereas if you don't claim it at all, they don't get that. So really important that people do claim child benefit. Now, if you have a client who's becoming a parent for the first time, their earnings are above £60,000, do still fill in the forms. Make sure they still get on the system, so there's no loss of NI credits. Child will also automatically get their NI number at 16, makes it easier for them as well. But there is a box now on that form you can, so you claim child benefit, but you tick a box and say, don't actually pay it to me, then you don't have to worry about these tax charges. The thing, obviously, for people that are just over it or just tipping over it is to consider pension contributions. So if I have an example for somebody who earns £60,000, has got 2 children, child benefit this year is 1885, going to 2075 in 23-24. Work out the income tax for the year, work out the child benefit charge, the high income child benefit charge. That would be 100% of the amount if you earn 60,000, because you lose it all. Got your tax bill there for the year. Alternatively, if you make a 10,000 personal contribution, so that would be an £8,000 net, 10,000 goes into the pension with the tax relief. Income tax bill for the year then comes down to £7,486, and you have no high income child benefit charge. So that 10,000 contribution saves 5,831 tax this year, going to £6,021 next year. So it's more than 60% tax relief on this. So that's actually a higher rate of tax relief than those people with the personal allowance issues. And because child benefit goes up annually with inflation, and the £50,000 limit where the high income child benefit charge kicks in has never changed since it was introduced, if it carries on like that, the difference is going to get bigger every year. So the savings you can make in terms of making pension contributions are going to get bigger every year as well. So just to summarise then on the tax position, basically nearly all of us are going to be paying more tax in 23-24 because of the freezing of the bands. But using pension contributions can help mitigate some of these increases. And with the budget announcements, you know, there's so much more you know, that can be put in. The iron allowances going up, and you know, people that previously couldn't pay in with some of the protections might be able to pay in after 6th of April, and not having to worry about the lifetime allowance as well. Particular pinch points, you know, with the child benefit charge and the loss of the personal allowance, where contributions can be even more valuable, and especially with the childcare element if you do have parents who are tipping over that £100,000 mark as well. Okay, so moving away from tax and tax issues, let's have a look at what the FCA are up to. Consumer duty, obviously, is the biggest thing that's on the FCA agenda. So we have this timeline, which some of you may have seen. I've used this before. We had all the final information, documents, rules back in July last year. First deadline has passed, so larger firms had to submit our plans to the FCA. So we were one of those. We did that back in October. Next deadline we've got approaching is the 30th of April. So this is where we as manufacturers, as we are in consumer duty world, we have to share key information with you as advisors, our distributors of our products, by the 30th of April. So in order for you and us both to be able to implement the duty by 31st of July. There is a second deadline, a year, 12 months further on for closed book products. That doesn't affect us because we don't have any closed book products, but it may impact you because you may have clients who are in closed book products. So that's the sort of timeline that we have. So the first part of that was the plans going to the board on the 31st of October last year. The FCA, based on that, have had a review, basically, you know, on the larger firms with dedicated FCA supervision teams about their plans, seeing what they're happy, what they're not happy with. The feedback from that was ours was fine. They were very happy with what we were doing. They did have some concerns with some firms. One of the areas in particular was that they hadn't appointed somebody senior enough to be the consumer duty champion, or they were just saying the responsibility fell on the whole board rather than on an individual, and basically they made it clear they're not happy with that. That's not their intention. That's not what they want firms to do. They also said that in the next few weeks, when this was the end of January, so kind of put it past that a bit now, the survey was going to be sent to 600 small, medium-sized firms. So some of you may have had that, which is basically sort of the next stage, because the first bit was just larger firms, smaller firms, to get an idea of what small and medium-sized firms are doing to implement the consumer duty as well. So this review they've done based on sort of the first stage, they've come back and said there's 3 key areas they want firms to focus their attention on. The first one they've said is about effective prioritisation. So this is about focusing on areas that's going to make the biggest impact on outcomes for your customers, consumers on that. The second one is about embedding substantive requirements. So about making sure changes needed, you make the changes needed so customers, your consumers, clients receive the communications that they understand, that the products and services that they are taking up meet their needs of fair value. And also there's a big bit in there about customer support, making sure people get what they need, not just part of the sales process, but after sales, vulnerable customers all comes under that as well. And then the last one they said is about working with other firms. So this is about, working closely with your commercial partners, making sure, we all deliver good customer outcomes. There's a chain, a consumer duty chain, isn't there? You've got investments, on a platform in a SIP wrapper. So, you've got the fund managers are in there. There's us as a SIP provider, there's you as advisors, there's a whole chain there, for the client. So making sure we all work together. So, sort of as part of that, I suppose my question for you is, what we can do to help you. So, we have a deadline, let's say 30th of April, for us to share information with you. We are planning to share price value assessment information, information on products and services, target market information, to help you meet your consumer duty. But this was the question, is there anything else that you want from us? And if there is, then, please do let us know what else we can do to help you meet your consumer duty. Moving on, FCA have also said they are going to conduct thematic review of retirement income advice. This review is beginning Q1 this year, so kicking off now, with the aim of publishing their findings before the end of the year. Firms, I'm guessing now, because they said this in January, that firms selected for the review can expect to be contacted early in 2023, so they probably will have contacted most of them by now. But the results of this will be sort of an indicator of how firms are implementing consumer duty in this area. So want to watch out for. Pensions dashboards, I talked a bit about this when I was out on the road. We've had a lot more updates from the FCA, DWP, pensions dashboard plan, lots of things like this. We had a deadline for connecting to the dashboard of 31st of August 23. However, it was announced by Pensions Minister that it is all now on hold. So there's been a few issues with the pension desk programme, the testing and things not going as smoothly maybe as hoped. So we're keen to stress that it is still going to happen, it's still going on, we should still be preparing for it. But in terms of the timeline, we're waiting to see the revised schedule on this. So when I say on hold, I suppose it is kind of on hold, but we are still doing work on this, and it is still coming, it is still preparing for it. A few other bits and pieces. We had out from the FCA at the end of last year this paper on non-workplace pensions, which was sort of long awaited. There's two main things in this paper. First one doesn't really impact advisors, but just so you're aware of it, from 1st of December next year, 1st of December this year, 2023, we will have to offer default option, investment option to non-advised customers in non-workplace pensions. Somebody joining our SIP will have to be offered a default, even on the non-advised side of things. It's not like auto-enrolment where, if you do nothing, you end up in that fund, because they still have to actually say, yes, please, I'll have the default, but we have to offer it prominently, a ready-made standardised investment solution on that. You don't have to discount it before recommending other investments in the same way you should do with investment pathways. So it's fairly straightforward for you. But the other part of this, which does affect clients whether advised or not, is about cash warnings. So pension providers will have to issue cash warnings to any customer with significant sustained levels of cash in their non-workplace pension. So this applies to all customers, takes place every 3 months. We have to assess it, and those who are caught with they have £10,000 or more in cash, and that is more than 25% of their fund, then we will have to issue cash warnings. And we will have to send those directly to clients. Obviously, we will tell you when we're doing it, but we do have to send them directly to them. So again, that's 1st of December that comes in. Last little one from FCA is on the future disclosure framework. So a discussion paper came out at the end of last year. This is all it's all related to Brexit, basically, because we don't have to follow the EU rules anymore. So we're looking at this afresh. So this is disclosure, very wide ranging, sort of not just, illustrations, key features, kids, all disclosure products, looking at views on how we deliver disclosure, the presentation of it and the content, what goes in on that. This consultation will, sorry, this isn't a consultation, this is a discussion paper. A consultation paper will follow probably in the next few months on that. And then after that, we will get, policy statement and changes coming. So it is the very early stages, but yeah, it looks like changes to disclosure are coming. Finally, I'm going to wrap up with a little bit of industry news. So we had a few bits and pieces out from the DWP at the end of January. First thing was around value for money. Now, this is actually a joint piece of work from DWP, FCA and TPR, and it relates initially just to workplace pensions, but the FCA have said that they will consider, basically their intention is to expand this at a later date to non-workplace pensions as well, including SIPs, including pensions and decumulation. So probably not a direct impact for us just now, but it is coming. Obviously, you will have clients that may be impacted in workplace pensions elsewhere. So for value for money, they're looking at doing a framework with a RAG system which will look at investment performance, costs and charges, and quality of service. They'll get a RAG rating. Depending on those ratings, certain action will have to be taken by the trustees on that. So this is a consultation. Deadline is 27th of March. It turns exactly when you're watching this, whether it'll have closed or just about to close on that one. The other one they released same day with the same deadline is about collecting defined contribution pension schemes. So at the moment, I think the only one up there is this Royal Mail scheme, but they are looking at the possibility of having multi-employer CDC schemes available. So we're looking at that. And then the last one they've got is about small pots. So this is a call for evidence. So early stage of the consultation process. But small pots isn't anything that we haven't looked at many times before, I think. So the two main proposals in this are, one is around pot full of member, and the other one is about having auto consolidation, so where pots are below a certain size are auto consolidated into these, big providers that are selected for these purposes. So there's questions in there about, what's the appropriate size of pot is for that to happen. As I say, I'm not sure. It still really deals with the issues, of protection, people transfer, or just, people transferring automatically being consolidated into a product which then has higher charges and things like that. Yeah, that's all out there as well. One thing which was mooted, but we didn't hear anything of in the budget, was about the increase to state pension age. So there were reports out in January saying that was going to be in the budget. They were going to bring forward the increase to age 68. Obviously, we didn't have anything on that. But, we are still due. This review has to come out by May. It's due, the state pension age review. We know it will be going to 68, age 68 at the moment. It's, planned not to happen until the 2040s. But, the reports were whether it's going to be brought early. I'm sort of cautiously optimistic because we haven't heard anything that they might not do anything with that. But, obviously we'll have to wait and see till the review, comes out. Obviously, we know when other people have tried to change state pension age, what's happened with our friends across the channel. That's only going to 64, and that's not going very smoothly for them there. So we'll wait and see on that one. Final bits and pieces I'm going to talk about, just a few bits from the IFS. The Institute for Fiscal Studies are a think tank. So they're not government, they don't make policy, but they are in the ears of government and have some influence. They had a few papers out recently. They've been very active in the pension space. Just before Christmas, they had this first report on death and taxes and pensions, basically saying that the tax treatment of pensions on death is far too generous, and the system basically encourages people to use it for passing on funds down the generations, and not use it for pension. I'm sure you've all had conversations with wealthy clients and basically on the lines of use everything else first, touch your pension last, because it's outside the estate, pass it on. And I think the changes in the budget in terms of the removal of the lifetime allowance is only going to encourage that, plus your increases in annual allowance is only going to encourage it even more. It kind of goes against what the IFS were saying and wanting to do. So what the IFS were proposing in this is that there should be an income tax charge on all funds that remain in the pension on death. So none of this, if you die before 75, it's tax-free. You'll be taxed for everybody, any beneficiary, as income tax. I think that would be relatively easy to bring in, and probably not too controversial, really. But the second part was that they should bring pension pots within a deceased estate for the purposes of inheritance tax, which obviously would be a lot more controversial. And can't see massive changes given the fact we've just had the budget coming in any time soon, but certainly if we had a different government, they have very different views on these things, and I know they've already talked about saying they would want to reverse the abolishment of the lifetime allowance, but in practice that might be quite difficult to do, whereas this we'll see anyway on that one. Other one from the IFS was a sort of a wider piece on better tax treatment of pensions. So there's a lot of proposals here on tax relief, how tax relief works. So in the past, we've had lots of rumours about flat rate relief. 30% is often the rate that's been quoted, but having a flat rate relief doesn't work. They acknowledge that in this report. There's lots of issues because you just have employer contributions, how it works with DB schemes. So they have come up with a different proposal, which is about having basically the equivalent of NI relief on personal contributions, because that would benefit people on lower incomes more, because if you're taking your top slice of income and putting it into your pension, if you are a basic rate taxpayer, you're paying NI 12% on that, whereas if you're a higher rate taxpayer, you're only paying 1%. So the relief helps those on lower income rather than those on higher income. It also talks about removing NI relief for employers completely. So it would help you. Employers would pay NI on pension contributions in the same way they do on salary, but replacing it with a subsidy instead. So employers wouldn't be worse off, but it would be more evenly spread. Because at the moment, obviously, there are some employees where the employer doesn't pay NI, so you sort of get rid of that element on it. But the flip side of this would be that you would pay national insurance on pension income. So that's quite an interesting idea because it's something quite different to any sort of proposals we've seen before, which you can see sort of some kind of reasons, sort of logic behind that. But it's a big change. You'd hope they would do consultation on that before anything came in, if they were ever going to do anything like that. In the paper, they also talked about increasing the lifetime allowance. Well, we know what's happened with that. They thought about putting a cap on PCLS. They were talking about making it quite a lot lower than the cap we know is coming in now. They were talking about 25% of 400k, so a 100k cap. Yeah, I'm not sure, given the changes we've just had, how likely we're going to see that anytime soon. Final thing I'm going to mention from the IFS is a much bigger piece of work they're doing. Obviously, they've had the few papers recently, but this they've announced this, they're going to do this pension review. So this is a big 2.5-year project to comprehensively assess the consequences of current pension policy, look at the economic environment and look at the individual behaviour and what it means for the future of living standards in retirement. This is intended to provide recommendations for reform to improve outcomes for future generations of pensioners. 3 sort of key questions they're going to look at and explore in depth. Are people saving enough for retirement in terms of the amount of form of savings? If they're not doing that, how can government policies help? Looking at how the state should support people from later working life into retirement. and whether people need more assistance to use their wealth appropriately through retirement. So review is going to be launched April 23, so imminently. First findings are expected to come out sort of autumn this year, and then the main report, the key findings and all the recommendations are due sort of summer 2024. So that's a big picture stuff, looking at all that, which may shape future government policy. We shall see. But that is all for my roundup for today. I do hope that's been useful, and as I say, we do intend doing another more in-depth bit on the budget changes relating to pensions, so look out for that one. But thank you.
Thank you, Lisa. So that concludes our webinar for today. Should you need to contact me or any of the speakers, please drop the details in the comment section on the automated feedback form, and we'll get in touch very soon. Quick reminder that your CPD certificate and a copy of the slides will follow via email in the next few days. We have a few online sessions this week for various regions, so bear with us and we'll have your follow-up over to you soon. So all that is left for me to say, thank you very much for joining us. We hope to see you at the next one, and bye for now.